Hello everyone, happy day, very happy day and happiest day. Hope you people are doing really great. Okay, so today we are going to start consolidated financial statements revision. Ultimate best, I'll teach you in such a way that you are able to understand everything in one particular sequence. I'm going to teach, follow the same sequence, and you are going to fall in love with consolidated financial statements. After AS 21, 23 and 27, we are going to upload. So enjoy, it's for you people, and you will have super duper clarity. I'm going to have all the concepts covered along with the sums. ICA sum also I'm going to do. So you are going to love the standard and you are going to score high marks. So let's begin with what? AS 21. Point number 1. Sir, why are we learning this particular standard? Okay, I will tell you the reason, because if you know the reason, it will be very easy for you all. Clear? For example, assume we are a company, we are raising a capital. Okay, what is the journal entry will pass when we when we raise a capital? Bank account debit to equity share capital. Assume we are raising 500 lakhs. Okay, what is the entry will pass? Bank account debit to equity share capital 500 lakhs and 500 lakhs. Correct? So what happens in our balance sheet is our equity share capital will increase by 500 lakhs. Similarly, bank balance also will increase by how much? 500 lakhs. So balance sheet will be tallied. Correct? Using this bank balance, what we will do? We will purchase asset, we will do the business, we will earn the profit. Correct? So assume. Okay, see, using this bank balance of 500 lakhs, assume I am purchasing PPE. Okay, I am purchasing PPE 200 lakhs and bank balance will be 300 lakhs. So if you all see, equity and liability reserves will be in the form of asset. It can be any asset. People don't see this as cash or bank, or corresponding to that will be in the form of asset. It can be any asset. Clear? What happens is I may even invest this amount. Correct? I may even invest this amount in some other company. Correct? My first question is, if anyone sees this balance sheet, whether they say it is a good balance sheet or bad balance sheet, they'll say okay, fair balance sheet, not even bad, not even good. Okay, fair balance sheet. Correct? But listen, using this money, okay, using this money, if I make profit, okay, what will happen? Bank balance, okay, PPE is there. Correct? Assume it is 200 lakhs. Using the some amount, using some amount I am purchasing, I am selling, and I am making profit. That profit will go to reserves and surplus also. Correct? So equity share capital will not change. Reserves and surplus, okay, reserves and surplus, assume to this year we have earned a profit of what? 100 lakhs. So our liability side, equity and liability side is what? 600 lakhs. And the bank balance after sale, assume everything you have sold and you made a profit. Okay, and what happened is 300 lakhs and there is a profit of 100 lakhs. So it comes to how much? 400 lakhs. Therefore balance sheet will be tallied. If someone sees like this, okay, if they are seeing reserves and surplus, what they think? Aha, super, he is performing really good, he has made a profit of 100 lakhs this year. So good balance sheet. If you see, sir, this is good. Correct? How a bad balance sheet looks generally on the face, by seeing the face of the balance sheet, how we will conclude is whether it is good or bad. Assume there is a equity share capital 500 lakhs. Okay, and bank balance 500 lakhs. Using this bank balance, I purchased goods, everything got fired, or you are not able to do the business. You're people are shifting to some other product. There is a change in the market. So, but what you have done is you have purchased goods, no one is purchasing. Correct? You are not able to sell, full loss. So, how your balance sheet will look is, assume you are purchasing. So, purchases account debit to bank account. Just to understand you, I am telling you 500 lakhs and 500 lakhs. You are not able to sell. So, this you are closing and take into P&L. P&L will have only debit. So, there is going to be a loss of 500 lakhs. Correct? So, the loss we will take it to what? P&L debit balance. Correct? So, how balance sheet will appear is equity share capital. There is how many lakhs? 500 lakhs. Bank balance will not show any balance because entire amount you are using. Correct? P&L is showing what balance? Debit balance. Actually, P&L debit balance here only we have to show. To make you guys understand, P&L debit means accumulated loss or loss for that year. This I am going to take it to what? Balance sheet. This accumulated loss 500 lakhs. If anyone sees this balance sheet, whether they'll say it's good balance sheet or worst bad balance sheet, they'll say because they are incurring losses. Clear? Sir, why are you teaching this? Listen, now story starts. Okay, assume kada our company is there. Okay, our balance sheet is there. Already we are having equity share capital. Okay, assume we are having equity share capital of 100 lakhs. We are having equity share capital of how much? 100 lakhs. And we are having bank balance of what? 100 lakhs also. Using this bank balance, what we did is we thought, okay, let us invest in some other company and get what? Capital appreciation and whatever income we are generating, let us enjoy. Like that we decided. Entire 100 lakhs what we have done? We have invested. So assume we are investing. Investment in what? S Limited. Investment is an asset. investment account debit to entire 100 lakhs, I'm investing 100 lakhs, correct? So investment in S limited account debit to bank account, how many lakhs? 100 lakhs and 100 lakhs. So what happens is this bank balance will no more be a bank balance, it will be converted into investment in S limited, correct? How much? 100 lakhs. Clear, Ama? So assume our company name is H limited, our company name is what? H limited, and the investment in S limited, and we went to balance sheet of S limited. Balance sheet of S limited, they have raised capital of how much? Assume they are raising capital of 100 lakhs. Entire 100 lakhs we are purchasing. Sir, how, sir? We can get it. Clear? So assume they are raising the capital of 100 lakhs. Entire 100 lakhs we only sponsored. Clear? Means 100% holding. So more than 50% if you are having, it means we are holding their what? Subsidiary company. So entire 100 lakhs we are having. So this investment is 100% control in what company? S limited, which becomes now subsidiary limited. Using this money, sir, what entry these people will pass, sir? S limited. They will pass what entry? Bank account debit to equity share capital. For them it is equity capital. For us it is investment. For them it will appear in equity share capital liability side, that is under equity, and for us it will be investment. Clear? If it is long term investment, non-current asset. Okay, so they will pass bank account debit to equity share capital 100 lakhs and 100 lakhs. So if I see this balance sheet, if someone comes to us and they're asking, sir, show me your balance sheet. We are showing this balance sheet. Sir, you made an investment of 100 lakhs. Super, sir. Super performer, sir. Your financial position also looking great. Correct? If someone comes and sees S limited also, as on today, oh, you have raised the capital. Okay, let you do the business. Then I will conclude. Correct? Now, what are the two possibilities is, listen. Okay, S limited will do the business and they make the profit. Correct? When they make the profit, it will look like this. Correct? Equity share capital, reserves and surplus will be there. Other assets will be there. All assets. Correct? Then people say, okay, they made a profit. Assume positive balance. Clear? They made a profit. Super. Correct? But what is the case? Using this capital. Okay. Now assume this capital 100 lakhs. Entire 100 lakhs has become what? Loss. Entire 100 lakhs bank full it has become loss. If someone sees S limited balance sheet individually, correct? What they say, array S limited is bad balance sheet, correct? If someone comes to us and asks separately, with separately they're asking, array show your balance sheet, you are showing like this, correct? So if someone comes to us and they are asking, array H limited show me your balance sheet, what we are showing is equity share capital 100 lakhs, investment in S limited 100 lakhs. If someone sees this, super, they made an investment, super, no problem. Now people will come and pat you. Okay, super, 100 lakhs you're having, correct? But our 100 lakhs only we have invested in what limited? S limited. In their balance sheet, if you see, using our equity share capital of 100 lakhs, they made a profit or loss? Loss of what? 100 lakhs, correct? Correct. If someone sees S limited separately, whether they say good or bad, bad. If someone sees our balance sheet separately, they'll say good or bad, good. Correct. But we only know, array, our 100 lakhs only went to what? S limited as equity share capital. Using this, they made a loss of 100 lakhs. We are having 100% control over S limited, correct? Therefore, our money went to S limited as equity share capital. That has become loss, correct? Therefore, taking this off in net, if they are incurring loss, who is having control? We are having control. If they are making profit, correct? See, to the entire world we are telling, we made an investment. But in reality, if you tell whether we are having profit or reality is we are also incurring loss, we are also having loss because our money only they use and they made it as a loss, and that too we are having 100% control. In net, this loss is subsidiary's loss or this loss is actually in reality, in substance, it is our loss. It is our loss. Therefore, accountancy says to see the reality. The reality is not your investment, you are having good balance sheet. The reality is your money only went like that, that has become loss. Therefore, this capital 100 lakhs is actually what good, it is actually performing well, or the position is very bad. If you see separately, your position looks good, but if you see this only went like that, if you nullify this, okay, if you take this, your capital only has become what? Loss. Therefore, reality is whether H limited is performing well, whether our position is good, our position also not good, our position also not good, correct? But if you see separately, what they are telling, you are having investment, good to know, correct? But in reality, our capital only has become loss. We have to tell to the people reality or what? Window dressing. We have to tell the reality. That's why accountancy says this capital only has become loss. No, therefore, in reality, the story is H limited, okay, if you see, the H Limited capital of 100 lakhs has actually become a loss of how much? 100 lakhs. Therefore, H Limited as a group, they are not performing well. Their financial position is not good. Correct? So this is what is the reality. Whether this is individually it is reality or as a group this is the reality. As a group this is the reality. We have to tell reality to the people. The window dressing is not important. To tell the reality to the people only, what we are doing, we are clubbing H Limited and S Limited. When you club holding company and subsidiary company and you present the financial statement together, when you merge holding company and subsidiary company, if you present the financial statement together, if you consolidate a holding company and a subsidiary company and you present the financial statement, that financial statement which is consolidated to tell the reality, that financial statement which we are consolidating is called as consolidated financial statement. The main reason for consolidated financial statement is to tell the reality to the people. Clear or not clear? That's why we will do the consolidation. Clear? So consolidation, whenever we are doing, two things are, see, there are many points. Point number one is when you consolidate, okay, when you consolidate, what they are telling, this investment only meant to see the reality, investment of holding company, equity including reserves and surplus if any. Clear? Because reserves and surplus means what? At the time of investing they are having it. Correct? So on the date of investment, if there is any reserves and surplus, for that we should not take share in that. For that we have to pay what? Investment in cost. We have to invest accordingly. So what they are telling is at the time of consolidation, don't take investment value of what company? Holding company and equity of subsidiary limited. Then only you will know the reality. So rule number one, or logic, actually it is logic only. What they are telling is at the time of consolidation, eliminate investment of holding company and equity and reserves and surplus. Equity, share capital and reserves and surplus of which company? Subsidiary company. If you nullify only, you can know the reality. You can know the reality. Sir, then we should not take reserves and surplus. I will tell you when to take. Hold on, I will tell you when you have to take reserves and surplus. Why you are going to take, that time I will tell you. Okay, wow. So first point, at the time of consolidation, we are eliminating what? Investment of holding company and equity, share capital and reserves and surplus of which company? Subsidiary company. Then only we see the reality. Clear? Point number two, at the time of consolidation, we have to calculate goodwill or capital reserve, which will call it as cost of control capital reserve. Clear? So point number one, eliminate investment in holding company and eliminate equity, share capital, reserves and surplus of subsidiary company at the time of preparing consolidated financial statements, especially balance sheet. Correct? Second, they are telling at the time of consolidation, we have to find goodwill or capital reserve. Clear? Point number 3. Okay, while calculating goodwill or capital reserve, what should be compared, that I'll tell you. So two things you remember, we have to eliminate investment, equity and what? Reserves and surplus of what? Subsidiary limited, and we have to find goodwill or capital reserve. Clear? When you have to take reserves and surplus, I will tell you in short time when we do the sums. Clear? Third point is we can hold either 100% or less than 100%, but minimum we have to hold what? 50% to have control. When there is control, we can apply this AS21. Clear? Control generally how we will get, sir? When you are holding more than 50% of the voting right in another entity, then you will have control. Or when you are having power to control the composition of board of directors or any governing body, okay, that time you will have control. When you are having control, you are called as holding and that other person will be called as subsidiary. You being a holding should do the consolidation. Clear? When I say consolidation, means consolidated financial statement. Sir, what are the things we are going to learn, sir? In consolidated financial statement, first we are going to learn consolidated balance sheet. Then we will be learning what? Consolidated P&L. Then we will be learning what? Consolidated cash flow statement. Clear? In this, who is hero, sir? Consolidated balance sheet is very, very important. Okay, these people are very, very easy. So predominantly standard is hero of the standard is consolidated balance sheet. P&L and cash flow and all very, very easy. 10 minutes we can finish it off. So let's focus on the hero. Consolidated balance sheet. What balance sheet? Consolidated balance sheet. To take you to further questions, I will teach you one sequence. Okay, I'll teach you one sequence, then I'll take you to how we have to do the procedure. What sequence I'm teaching, follow the same sequence, you'll get the answers cakewalk, you'll get it. Clear? So before I take you to the formatting and all, let's focus on this. This notes, once again I'm telling you, this will be available in Telegram, Case Academy Telegram channel. Download it and write whatever you are writing. Please make sure you are practicing also. Please, my request it is. Clear? Because when you practice only, you will have the flow of doing the sum. Point number 1. Okay, let me quickly run through the sums. We will finish off as quickly as possible within short time. How much our score we are going to score, let me teach you. I'll try my level best so that I'm covering everything in a single shot. Clear? Balance sheet of X Limited on 31st March. Equity share capital already we are having what? 1000. Okay, everything assume as lakhs. Okay, non-current liability, current liability nil. I have given investment in equity shares of what limited? Y Limited. Therefore, we are called as what? When we invest, we are called as holding company. This Y Limited should be called as what? Is subsidiary company or subsidiary limited. Clear? Subsidiary company. Point number 1, how much we are investing? 1000 lakhs we are investing. What is the date of acquisition? 31st March 2020. Or how much control we are having? 100%. Sir, they will give the controller, they will give, or they will give number of shares we are holding on the date of acquisition. Also, on the date of acquisition, how many shares we are holding, that we have to consider for finding what? How much percentage of degree of control we will call, or pattern of holding. That to find on the date of acquisition, how many shares they are having, in that how many shares we are holding, like that we have to find the control. Clear? So 100% control we are having. Okay, in subsidiary limited, equity shares are how much? Equity share capital 800 lakhs, reserves and surplus 200 lakhs. Okay, non-current current liability and non-current liability, current liability nil. Okay, non-current asset, current assets we are having. Okay, point number 1, what they're asking, prepare CBS. Okay, see, totally I'll be teaching you 5 steps. In the 5 steps itself, I'll make sure entire consolidated balance sheet is done. 5 steps. If you cross second and third step properly, fourth is okay, easy only. Fifth is very easy to, when step 2, 3, 4 it is done, consolidated balance sheet will be tallied automatically. Okay, be conscious when you're doing this. Sir, what is the step number 1? I'll call it as dates. DOA, DOB, DOC. DOA means what? Date of acquisition. DOB means what? Date of balance sheet. DOC means what? Degree of control. Sometimes we will call it as shareholding pattern. Clear? So DOA, when are we acquiring? 31st March 2024. DOB, remember whatever I am writing, just go in the same sequence, so that will be easy. DOB. Okay, DOB means what? Date of balance sheet. See, whatever balance sheet data they have given, that date also you write, and consolidated balance sheet date also you have to write. So date of balance sheet. What is the date of balance sheet given in the sum? Given balance sheets are what? 31st March 24, 31st March 24. Correct? So I have written given balance sheet dates. What is the CBS date they're asking? If nothing is given, that day only they're asking. Clear? 31st March 2014. 31st March 2024. See, date of acquisition, date of balance sheet, in the sum it is same. Okay, when I go to after second or third sum, it will be different. If it is different, how to do, I'll tell you. Okay, as on now it is what? Same balance sheets. Okay, so date of acquisition, date of balance sheet given, and consolidation they were asking what? Same balance sheet. So if there is if same dates are there now, it will be easy only. Clear? If different also, double easy. Clear? So degree of control, how much control we are having and outsiders are having. Okay, how much control we are having? 100%. So holding company's percentage of degree of control, shareholding pattern is how much? In the sum 100%, but all the sums it will not be 100%. Clear? If we are having 100%, whether outsiders will have anything? Nothing. Correct? Therefore I am writing it as what? 0. Outsiders are called as what? Minority interest, because majority when we are having minority interest, who will have? Others will have outsiders. Clear? Outsiders will be called as what? Minority interest. Clear? Step number 1 is done. What is it? DOA, DOB, DOC. Okay, step number 2. Step number 2. What we have to do is we have to calculate goodwill or capital reserve as on the date of acquisition only. Sir, why on the date of acquisition? When you are getting control only, whatever is the net assets, okay, whatever net assets you are acquiring, for that you are paying something. So what we received, okay, what we are paying, in that only we know goodwill or capital. So if you pay more than the net worth you are getting, that is called as goodwill. Sir, net worth is 400, sir, I am paying 380 only. Correct? Means for us it is what? Profit. Capital is you have to take. Clear or not clear? So we have to check 2 things. What we paid, what is the net worth we are getting, what is the net worth, what we are paying. Clear? So everything as on the date of acquisition, because that is the date on which we get control, that is the date on which we pay more or less. Clear? So that's why I am focusing on what? Don't change the linings. Also in classroom also 200 times I would have told, don't change the wordings. Each and every word has got a meaning which you also understood at the time of teaching you. Clear? Calculation of goodwill or capital reserve as on the date of acquisition. Clear? As on the date of acquisition only we need what? Goodwill or capital reserve. This goodwill or capital reserve only we are going to show it in what? To be shown in consolidated balance sheet of holding company. Who will prepare consolidated balance sheet? Generally holding company will prepare. Okay, sir, ultimate holding is preparing, then you are not required to do. Okay, listen, holding company, consolidated balance sheet, who is going to prepare? Holding company. Okay, so calculation of goodwill or capital reserve as on the date of acquisition. What is the goodwill or capital reserve? That goodwill or capital reserve reserve, we have to show it in what? Consolidated balance sheet, which we are going to prepare on what? 31st March dated. Correct. Point number 1. Goodwill or capital reserve is difference between two components. One is what we paid. Clear? What we paid should be called as this. What we paid for that 100%, 1000 lakhs, that we'll call it as cost of investments. That we'll call it as what? Cost of investment in subsidiary company as on the date of acquisition, 31st March 2024. What percentage? 100%. How much you paid? 1200 you paid. Correct? See, you are paying 1000 lakhs. You are paying how many lakhs? 1000 lakhs. For what are you paying is, sir, we are receiving this much net assets, sir. 100% we are receiving. Correct? So for this net assets, how much we are paying? So now we have to find what is the net asset or net worth of subsidiary company. In that, how much percentage we are holding. Clear? For that, how much we are paying is 1000 lakhs we are paying. So it should be compared with our share, holding company share of net worth in subsidiary company. Subsidiary company will have one net assets net worth. In that, what percentage we are holding? 100. So for that 100, how much we are paying? 1000 lakhs. Sir, first we have to find subsidiary company's net assets. No, yes, we have to find. For that, we are going to do one supplementary working. Clear? So to find net worth of what company? Subsidiary company. Net worth should be called as net assets or equity. We are having two approaches. Either you can follow asset side approach or you can follow what? Liability side approach. Asset side approach, how to find net assets? Total assets minus outside as liability. Go to subsidiary company. You have to focus on subsidiary company's net assets. For them only. We are actually acquiring that net assets. For that you are giving investment value of 1000 lakhs. Correct? For that you are investing 1000 lakhs. So first we have to understand now subsidiary company how much net assets they are having. So what is the total assets value? 1000. Is there any outside liabilities? No. So 1000 minus 0, what is the net assets? 1000 only. Correct? This is what approach? Asset side approach. 1000 minus 0 is 1000. So net assets is what? 1000. Sir, if I follow liability approach for finding net worth, some other answer will get. Same answer only you will get. First 2-3 sums I will do in both the approaches. In exam you follow one, so the time will be saved. Clear? If it is liability approach, they are telling either you are finding this. Correct? This is net assets approach. You will get same answer. If not this, there is one more way which will call it as liability side approach. Correct? So net assets, like net assets approach, either asset side approach will call, or straightly take what? Liability approach. Clear? Which will call it as equity. So net assets in this case is total assets 1000 minus 0 is 1000, or just to take up what? Equity and reserves. Okay, by equity, share capital and reserves, that will call it as equity. That also comes to how much? 1000 only. Clear, Amma? So liability approach, equity, share capital, reserves and surplus, net worth. Okay, so sir, net worth like this also you can do. You will get the same answer whether you go from asset side or liability side. So 1000 lakhs. Okay, sir, same answer only you will get. Yes, same answer only you will get. See, this is the net worth of what company? Subsidiary company. In that, how much percentage we are holding? 100%. Therefore, net assets of 1000, entire 1000 net assets we are getting. So the holding company, our share of net assets or net worth in subsidiary company. So net worth of subsidiary company is 1000. In that, how much we are holding? 100%. Therefore, what is the total net assets we are receiving from the subsidiary? 1000. For the 1000, how much you are paying? 1000. Sir, 1000. I am also paying 1000. I did not pay more or less. So goodwill or capital is wrong. Nothing will be there. Correct? Clear? So in this nothing will be there. But sometimes, sir, net worth of subsidiary is 100% we are holding. So entire net assets of 1000. For that, assume you are paying 1200. For 1000 you are paying 1200. Therefore 200 should be called as what? Goodwill. 200 should be called as what? Goodwill. Sir, net assets is 1000, sir, but I am paying only 900. I am paying less, sir. Okay, because I thought some other I don't think so he will have a business, sir, so I am paying less. Okay, sir, 1000. For 1000 worth of business, you are paying only 900. So for us, we are paying less now. For us, it is what? Profit, which should be closed and taken to what? Capital reserve. That should be called as capital reserve. That should be called as what? Capital reserve. Clear? One more point I'll tell you, Gana. For consolidated financial statement, will not maintain any separate set of books. There are no journal entries. Clear? There are no journal entries. All the things we are just giving to give the reality. Effects will be given directly. Clear? But sometimes we will pass journal entry. Notional entries will be passed for our understanding. So for consolidated financial statement, we will not maintain any books of accounts. No separate journal entry will be passed. Whatever we pass, it is notional entry for our convenience will pass. Clear? Point number 2. Sir, in this question, 1000 is the net worth. We are also paying 1000. Goodwill or capital reserve, nothing. If you pay more, more goodwill. If you pay less, capital less. Clear? In the sum, I'm making it as what? 0. Is there any minority interest? No minority interest. Outsiders are not even 1% outsiders we are having. So minority interest value to be shown in consolidated financial statement is 0. Sorry, sir. Okay. Sir, you said no to prepare step number 4. Actually, 5 steps are there. Okay, last step in the sum, I'll keep it as what? Consolidated balance sheet. Consolidation means what? Holding company and subsidiary company. Holding company and what? Subsidiary company. Line by line consolidation. What by line? Line by line. What do you mean by line by line is, for example, if non-current liability is there, this line should be consolidated with this line. Consolidation line by line means that value. Clear? Sir, you also said no one point. When we are consolidating, investment should not be taken. Equity and reserves should not be taken. Equity, share capital and reserves should not be taken. Then only we'll know, sir, this has become like this. Yes, at the time of consolidation, please don't consider this fellow. Okay, and you don't consider this. Sir, why, sir? Array, this fellow will be coming to consolidated balance sheet indirectly in the name of goodwill or capital reserve. It will be there, but not directly. It will be in the form of what? Goodwill or capital reserve. Because when I consolidate, I cannot show no investment. Correct? Investment 1,000 lakh. Equity and reserves and surplus 1,000 lakhs. Correct? 1,000 and 1,000. What happens within my company? I am showing an investment and equity and reserves. Correct? Not correct? Not correct. That's why it is eliminated. We are showing the net goodwill or capital reserve. That's why we should not take it. Clear? Point number 2. Sorry, sir. Then what do we have to do? Array, simply don't take this and this. Then, sir, if you don't take investment, if you don't take equity, share capital, reserves of subsidiary, equity, share capital, reserves of subsidiary company, then whose equity, share capital, reserves will be there in the consolidated balance sheet? Only holding company. That's why in consolidated balance sheet, equity, share capital of only holding, reserves and surplus of only holding. We will not take what? Reserves and surplus of equity, share capital of subsidiary company. When we will take reserves surplus, I will tell you. Wait, I will tell you. Don't worry. Clear? So holding company is equity, share capital is 1,000. Reserves is 0 as per the question. As per this question, it is 0. Non-current liability 0 0. Here also non-current liability 0 0. So even if you consolidate, 0 plus 0 is 0. 0 plus 0 is what? 0. That's why I did not write anything on what? And non-current liability and current liability. Clear? Hello? We did not write anything on what? Non-current liability and current liability. Clear? But non-current assets we'll see. Here we don't have anything. Here non-current asset is 0. Current asset is also 0. Clear? So here non-current asset is 700, 300. So when you consolidate, you will get what? Non-current asset, holding plus subsidiary, holding plus subsidiary. We are not in the sum 0, and holding subsidiary we are having 700. Similarly, total 700. Similarly, for current asset, holding is 0, subsidiary 700, total comes to 300. This is how we have to tally the consolidated balance sheet. Clear or not clear? Everybody listen to me, sir. But whether we have to prepare horizontal or vertical? Vertical no, so I will be teaching you vertical in some time. Correct? Why I am teaching you this sum is to have the control over the topics, to have clarity in the topics. Okay, to teach you some basics, I am taking up the sum. And now let us read. While preparing consolidated balance sheet, equity, share capital of subsidiary should not come. Similarly, reserves and surplus of subsidiary should not come in consolidated balance sheet. But when we have to take, I will tell you. Clear? Similarly, okay, one more point. Investment made by the holding company and the net worth of subsidiary company should be compared to find what are goodwill or capital reserve. That's where I have written no. What I have written, investment of subsidiary, investment in subsidiary company and the net worth of subsidiary company which we are holding, that both should be compared to find goodwill or capital reserve. Correct? Okay, to find the net worth. Correct? To find what net worth, we are having two approaches. One is called as asset side approach, other one will call it as liability side approach. Asset side approach, what we will do? Total assets minus outside liability. In the sum we got 1,000. Correct? Or there is one more approach called as what? Liability side approach. Same answers only. You will get equity and equity, share capital and reserves and surplus, which will call it as equity. Same answers only. You will get. Clear or not clear? Based on this, now let me kickstart to what? Other sums. Super sums in the same sequence you learn, so that you will feel super duper confidence. Okay, listen to me. Now let me run through this very quickly. X limited, Y limited balance sheet they are giving. See, when you want to consolidate, to consolidate, first what is required? Balance sheets is required. Okay, balance sheet of holding and subsidiaries balance sheet. Separate financial statements are required. Correct? This separate financial statements of holding and subsidiary only I can consolidate. Clear? The separate financial statement will be prepared based on respective standards. All the standards they will apply and they will prepare what are separate financial statement. When preparing separate financial statement, investment will appear at cost because that is as per AS 13. They would have followed AS 13. Only for consolidation we will follow what are AS 13. Clear? Or other for separate financial statements we will follow all the respective standards. Clear? And when you are doing so, in separate financial statement, investment will appear at cost as per AS 13. Remember that. Okay. Listen to me, Gana. So for the similar question, X limited, Y limited. Okay, share capital, how much? 600. This fellow is having 350. So all the data they have given. Okay, let me see additional information. Investment in Y limited, date of acquisition is 31st March 24. Investment in Y limited means correct. Then X limited should be called as what? Holding company. Correct. This fellow should be called as what? Subsidiary. How much we have invested? Investment data will be there in non-current investments. Correct. Under non-current assets, you will have one heading called as non-current investment. Under that you will have investment data. Clear? So investment made in Y limited, how much we have invested? 600 lakhs. Correct. 600 lakhs. And date of acquisition is 31st March 24. Okay, prepare consolidated financial statement on 31st March 2024. Clear? So let's start the answering part. Step number 1, DOA, DOB, DOC. DOA means what? Date of acquisition, 31st March 2024. DOB, okay, what I said given also, you write. Okay, when they're asking for consolidation, what is the date of balance sheet given in the question? 31st March 2024. What is the consolidated date they are asking? 31st March 2024. Dates are same or different? Same dates. When same dates are there, nothing to worry. Okay, if different also, nothing to worry. I'll tell you. Holding company is called as H limited. Subsidiary is called as Y limited. Degree of control, how much we are having in this sum is 100% control. Therefore, there is no minority interest in the sum. Next sum I'll take you to minority interest. Clear, Amma? Shall we start? Step number 1 is done. Step number 2 is what? Calculation of goodwill or capital reserve as on the date of acquisition. Correct. To be shown in consolidated balance sheet as on 31st March 2024. So on the date of acquisition, two components did I say? Correct. What are the two components? Number 1 is how much is our cost of investment for 100% on the date of acquisition. Correct. Sir, how much, sir? You said no, sir. You showed me 600 lakhs. Correct. Take 600 lakhs. Correct. This should be compared with what? Our share of net worth in what? Subsidiary company. Okay. As everything should be, see, monkey should match with monkey. Date of acquisition, 100%, 100%. Okay. Everything should be matching. You should not cross verify. Okay. How many times we would have learned in the class? Correct. So make sure date should be same. Date should be same. Percentage should be same. Clear? So holding company share of net worth in subsidiary company. So for this we have to prepare what? One supplementary working. Correct. So we have to find what is the net worth in subsidiary company. Okay, as on the date of acquisition. Correct. So supplementary working. Okay, calculation of net worth of subsidiary company Y limited as on the date of acquisition. Clear? Focus on that, sir. To find the net worth of subsidiary company and on the date of acquisition 31st March, we should also require what? Data of assets, liabilities on the 31st March. So let us see whether the balance sheet given in the question is this date balance sheet or some other date balance sheet. So we went and saw, sir, 31st March data only they have given. Correct. Then easy for us, sir. We also need what? Net worth as on that day. Whatever is the balance sheet date they have given, that is the date. So straightly we can take this value. Okay, ba? So focus on subsidiary company because we need a net worth or net assets of subsidiary company. So if you take up what liability approach, equity share capital 350 and 50. So you will get what? 400. You will get what, ma? 400. So see, 350 and 50, 400. No, sir, I'll go with asset side approach. Take asset side approach also, gonna. If you take asset side approach, okay, PPE and current assets, okay, total comes to 500. From 500, subtract non-current liability and current liability 100. 500 minus 100 comes to how much? 400. Sir, yes, sir, as you said, same answers only you'll get. Yes, same answer only you'll get. In exam, follow one, don't waste the time. Clear? So 400 lakhs. So in this, how much is our holding? How much outside is our? Sir, 100% we are holding, sir. Oh, we are getting entire 400 lakhs worth of business. Yes, sir. So we are getting 400 lakhs worth of business for against which we are paying 400 or more than 400 or more than 400. How much we are paying? 600 we are paying. Correct? So the 600 what we pay more is called as what? Goodwill at the time of what? Acquisition or consolidation. So this 200 lakhs we have to show it in what? Consolidated balance sheet. We have to show it in what? Consolidated balance sheet of which company? Holding company. Is there any minority interest? No. Straightly we'll go to what? Consolidated balance sheet. When you are consolidating, okay, follow the schedule 3 format. Please follow schedule 3 format. Particular note number and rupees. Equity and liability, shareholders funds, equity and reserves and surplus, equity share capital reserves and surplus of which company alone? Holding company. You should not take what company? As I said, don't take subsidiary company because their equity reserves and our investment will both are what are compared to find goodwill or capital reserve. So these two are compared. No, we have compared and found goodwill or capital reserve. No. So in consolidated balance sheet also it will come, but not as equity and but not as what are equity and reserves and surplus of subsidiary and investment or holding. It will not come directly. Net will be coming in the sum. There is a goodwill. That goodwill will show in the non-current assets under assets. Under that intangible asset. No. So show it in what are non-current assets 200 put together. You have to write. Clear? So it will come indirectly. It will come. Clear? Point number 1. Okay, sir. Equity share capital reserve surplus of which company? Holding company. So holding company equity share capital as per the question is only how much, ma? 600. We don't have any reserves and surplus. Here you should not take. So remember, you are not taking these two and investments. Other than that, you are taking everything. Clear? Is there any non-current assets and liabilities? Okay, 0 plus 70, 70. 0 plus 30 is 30. So if you go to consolidated, 0 plus 70, 0 plus 30, 70 and 30. So total comes to how much? 700. Similarly, let's go to asset side also. Asset side, don't take investments. Okay, take only others. So 0 plus 295, 295. 0 plus 205, 205. Correct? Along with that, goodwill also you are taking up. So 0 plus 295, 295 plus 200, 495 and 205. Total comes to 700. Your consolidated balance sheet tallied. Clear or not clear? Now coming to what are next sum, where we are not holding 100%, less than 100% we are holding. Shall we go? Listen to me. Go in the same sequence. You will love the standard a lot. Okay, there is a learning pattern. If you learn in the way in which it has to be learned, everything will be in your control. Clear or not? These people are having control over other company. You will have control. Okay, feel very happy about yourself. Okay, balance sheet of X Limited, Y Limited. So they have given this time all the values they are giving, everything they have given. Clear? Now question is, investment made in what company? Subsidiary companies only 80%, means 20% outsiders are having. Are yes or no? So point number 1, what is the date of acquisition? 31st March 24. Here also, what is the balance sheet date? 31st March 2024. Same dates only they have given. If the dates are different, what to be done, I will tell you. Clear? So date of acquisition 31st March, given balance sheet date 31st March, consolidated balance sheet date also 31st March. Here also in the same question, they correct. What is that? Question same like the first question. Balance sheet dates on the dates are same. Degree of control, holding company we are having 80%, minority interest they are having what are 20%. Clear? Holding company is X Limited, Y Limited. Step number 1 is done. Step number 2, calculation of goodwill or capital reserve. As on the, I am telling you repeatedly, goodwill or capital reserve we have to find only on the date of acquisition, because that is the date on which you are investing and getting control. That day goodwill and capital reserve only have to find it. Clear? So that goodwill or capital reserve, whatever you are finding, that should be shown in the consolidated balance sheet. Hello? Clear? So they are telling, sir, cost of investment as on the date of acquisition 31st March 2024, we are acquiring 180, 80 only. Correct? For that 80%, how much we are investing? Where is that? For 80% control, for 80% holding, how much we are paying? 800 we are paying. For 80% you are paying 800 lakhs. Correct? Now let me see. Total net assets of subsidiary will find. In that 80%, how much we are getting? For that you are paying how many lakhs? 600 lakhs. So let's find what net worth of subsidiary company. How many approaches are there? 2 approaches are there. Correct? One is asset side approach, other one is called as what? Liability side approach. Clear? So first asset side approach will go. Okay, go to asset side, total assets. Okay, what is the total assets value? PPE and current assets 850. 850 minus these two. 250. 850 minus 250, how much? 600. So net worth of subsidiary company is 600. Sir, please tell that liability also. No, I'll tell you. Listen to me. Liability approach also. What approach, ma? Liability approach. Where is the balance sheet? Liability approach. Take this two. Okay, 450 is the equity share capital of subsidiary. Reserves plus is 150. It comes to how much? 600. So whether you go with this equity share capital and reserves surplus, you are getting how many lakhs only? 600 lakhs only. So whether you are going with the liability approach or equity approach, your answers will be same. In that holding company share is what? 80%. Minority interest is how much, ma? 20%. Clear, ma? Clear? So 80% means how much? 480 lakhs. Here it should be 120 lakhs. Correct? Sir, for 480 lakhs worth of business which we are getting, sir, 600 is the total assets. In that we are getting only 80%. So for 480 worth of business we are paying 800, sir. We are paying more, sir. Correct? How much more? 320 you are paying extra. 320 should be called as what, ma? Goodwill we have to call, which should be shown in consolidated balance sheet. Clear? So this is, we are done with what? Step 2. Now, sir, in the some minority interest is there? No. Yes. Minority interest, step number 3. Okay, minority interest, step number 3. Minority interest. Okay, minority interest as on the date of acquisition. How much? 120. Okay, this is what we have to show it in what? Consolidated balance sheet also. Clear? Hello, sir, why we have to show in consolidated balance sheet? Wait and see the story. Clear? Let's prepare consolidated balance sheet. What most of the students they are thinking is, sir, consolidated balance sheet means what? Holding company plus our share of what? 80% we are having our share in the subsidiary company. But accountancy says you should not do proportionate and all. You should do full consolidation. You should do 100% consolidation. You should do what? 100% consolidation. Sir, 100% means entire assets, entire liability we will bring up. But 20% outsiders, no sir. Their assets, their liability also if you bring, their net assets also you are bringing. Correct? If you bring their net assets, they will hit us with stones, sir. Correct? Then accountancy sir, fully listen. No, why are you bothering? They are telling what to do. Tell me, sir. Accountancy says, I also know holding company and subsidiary companies 80% of assets, subsidiary companies 80% of liability only have to show. I also know this logic, correct? And holding companies full equity, reserves, everything you have to show. But what I am telling, don't bring 80%, do full consolidation. Means bring 100% of subsidiaries assets, bring 100% of subsidiaries liability. Sir, means you are telling, what are you telling, sir? Subsidiary companies 100% net assets we want to bring. Yes sir, we want to bring. But sir, 80 only we have to show. No, only 80% of net assets we have to show. No, correct. Now I'll tell you one more point. First you bring 100% of subsidiary company, 20% outsiders are there. No, their net assets also you are including. Show someone else net asset if you are bringing. No, it is our obligation, correct? Therefore we will show the outsider 20% as what are liability in our consolidated. Therefore 100, okay, this 20 in net we are accounting only how much? 80% net assets only, correct? You are also asking for what? 80%. Here also what I am doing, in net 80% only. So AS21 says, array, whether you show like that or this answer will be saved. But AS21 says do full consolidation, because for 20% data I don't want to go to some other place, everything included in one place so that I can see easily. The purpose of consolidation is to show the reality, show everything, correct? Then AS21 says do full consolidation. When you do full consolidation, net assets of what entire subsidiary you are bringing, including minority interest. Since you are bringing their net assets also, show them them in the liability side. Where we have to show, sir? After I will show you where we have to present it. Clear? It is neither equity nor a current liability. You have to show in between that. Clear? So this accountancy says whatever is a minority interest, first you do one thing, do full consolidation. Full consolidation means what, sir? Array, first don't consider this fellow and this fellow, okay? They will be coming in the balance sheet in the name of goodwill or capital reserve. They will come indirectly, they will come. Clear? Don't worry. Then what do you mean by full consolidation, sir? Full consolidation means for share capital and reserve surplus, show only holding company. Clear? So for share capital and reserve surplus, show only holding company. Minority interest as per what? Step number 3, 120. Clear? I said no, minority interest 20% means how much? 120. Now you bring all assets and liabilities, because you are showing that fellow as liability. Now what problem for you, they are asking. Clear? Now they are telling line by line consolidation. Okay, ours holding company and subsidiary company 100%, holding company and subsidiary companies 100%. Same with the case of what? Holding and subsidiary company 100%. Clear, ma? So that is what they are telling. Clear? So if you go to the balance sheet given in the question, what is the net asset? First PP is 200, 600, 800, 100 plus 250, 350. So 800, 350 goodwill as per calculation. Step number 2 you are getting. Clear? Sir, if you complete step 2, 3, 4, then answer will be easy. Answer will be double easy. Just you have to add addition. We don't know. Correct? That we have to do. And non-current liability, current liability also. Line by line consolidation, full consolidation. 350. 200, okay, 350 and 200, okay, 350, 200, minority interest as per step number 3, and the reserves and surplus, share capital of holding company. Add everything, your balance sheet will be tallied automatically. Clear or not clear? Therefore, what is the crux from question number 2 is do full consolidation. 100% net assets you are bringing means 100% assets, 100% liability. Even if outsiders are holding theirs also, you bring and do full consolidation. Whatever net assets you bought which belongs to the outsider, that portion you show it as a liability, as an outsider's amount. Clear? So that your balance sheet will happen, everything will be at the same place. Clear or not clear, ma? Everybody? Okay, now let us go to third question. Third question is also very easy. Revaluation impact. Slowly one adjustments I will start. Okay, look at the third question. Same set of values, means the same set of data, values are little different. Investment in Y Limited, date of acquisition 31st March, balance sheet given date also 31st March. Sir, same date, sir. Enjoy. Clear? Now one adjustment they are giving. at the time of acquisition, on the date of acquisition 31st March 2024, non-current asset of Y Limited is revalued at 500 lakhs. Means on the date of acquisition, this date also same, okay, date of acquisition, whatever the balance sheet they given, non-current asset, that is PPE, they are talking about PPE. PPE is valued at actually 600 they are showing now, but it is only how much? 500 lakhs. Clear? They are telling only this, I'll write it as PPE. Clear? PPE, they are revaluing at 500 lakhs. Sir, but they are showing 600. Yes, sir, because the revaluation of it is not given. Sometimes this also they will not give. See, when they don't give this data, but they are telling, this means indirectly they are telling impact I did not give, you do the impact. Clear? So they are asking us to prepare consolidated balance sheet. Yay, sort of be laddu for us. Finish it. Come on. First step. Clear? Sir, simple. Date of acquisition 31st March. Date of balance sheet given in the question is also 31st March 24. Consolidated balance sheet also 31st March 24. Same dates are different dates are same dates. Clear? Degree of control. Sir, how much control we are having, sir? 70%. How much outsiders are having? 30% they are having. Clear? So degree of control also I have written. Step number 2. What is step number 2? Calculation of goodwill or capital reserve as on the date of acquisition to be shown in consolidated balance sheet of holding company. Don't change the language. When you practice itself, practice in the same way so that in exam now quickly you will run it. Clear? Okay, last time how many students they have messaged me, sir, same steps, sir, like that I got the answer. Same story. I'm telling you, practice, you do. Same, like, sentences you try to reproduce, you will get the flow in the exam also. You can complete the sum in very quickly, maybe 15 to 20 minutes maximum, the big question. Cost of investment for 70% on the date of acquisition. On the date of acquisition for 70%, how much we are investing? 500 lakhs. Okay, 500 lakhs. Now what we have to find is their net worth on the date of acquisition, how much? In that 70% we are getting how much we have to find. Correct? How many approaches? 2 approaches. One adjustment there. First, asset side approach, liability side approach. Asset side approach. Okay, mama, asset side approach. Okay, whether we have to take 600, the real value on the date of acquisition, real value. What is the value? 500 lakhs. So 500 plus 300. How much, ma? 500 plus 300, 800. From 800, subtract this current and non-current. Correct? So 170. So from 800, subtract 170. What is the net worth? 630 we are having. Sir, liability approach also, please teach us. No, sir, I will teach you for liability approach also. Clear? Liability approach, what we used to do? Go to subsidiary. After understanding this much, don't see the holding company. Ante kada. Clear? Please don't do that. Go to subsidiary company. Subsidiary companies. What is the reserves and surplus? 600, 130. But this reserves 130 is before adjustment, after adjustment, before they did not do the revaluation impact. Sir, 600 worth of asset we are revaluing to 500. Revaluation loss. Revaluation loss means what is the journal entry? P&L account debit to PPE account. Correct? How many lakhs we have to reduce? 100 lakhs and 100 lakhs. Therefore, this P&L 130 it is there now. It is wrong. We have to reduce the P&L by 100. Therefore, the real value of PPE is only how much? That is reserves is 30 only. Clear? Therefore, when you go to liability approach, when you go to asset approach, what have you taken? 500 you have taken. When you go to asset side approach, 500, because value of PPE you are reducing by how much? 100 lakhs. Correct? So from 600, correct? From 600, if you subtract PPE, the credit 100, it will be 500. Correct? No, sir, I'll go with liability side approach. Then they are telling, then give the adjustment. 130 is there, it is wrong. Subtract this P&L, because P&L debit means it will decrease the P&L balance. So 100, 130 minus 100. Therefore, reserves is only how much? 30. So 600 plus 30, how much? 630. Correct? So where is that? 600 is equity. Reserves is only how much? 30. So how much is this? 630. Clear? Clear? This is easy or not? In that, correct? In that, how much is holding company we are having? 70%. So in 630, 70% comes to how much? 441. 30% outsiders are having. Clear? So for 70%, which is 441, we are getting, see, subsidiary companies having net assets of 630. In that we are having only 70%. We are having only how much? 70%. 70% means what? 441 lakh of business we are acquiring by paying 500 lakhs, means we are paying extra of how many lakhs? 59 lakhs. Able to understand? This we have to show it in consolidated balance sheet. Sir, that's it. Promise on you. That's it. Clear? After the same story, whatever you have done. Clear? Hello? Sir, same thing. Listen, this able to understand, this you are able to understand. Same thing you can do. But I see sometimes what and all they'll do, instead of doing this, okay, instead of telling holding company 441 straightly and minority 181, how they will write, actually, I'll teach you through liability side approach. Okay, this 189, 441, how they will write, in the 600, see what they're telling is 600, 130 minus 130, this 630 are dividing into 70 and 30. Means in this 70%, in this 70%, in this 70%, in this 30% for minority, 30% for minority. Whatever you will get the same answer. No, they are telling. Instead of taking up the total into 70 and 30, sometime ICA, majority of the sums, how ICA writes this 189, 441 is, in this equity share capital, minority is having how much ma? 30%. So minority share of equity share capital 600 into 30. Minority share of reserves and surplus 130 into 30. Minority share of what? Revaluation loss 100 into 30. Correct up. So 180, 39. This being a revaluation loss is subtraction. So how much you are getting? 189. Then sir, if for minority this story 189, for 441 what they'll do? Same story. What they'll do? Holding company share of equity share capital 600 into 70. Holding company share of reserves 130 into 70. Holding company share of revaluation loss 100 into 70. They will do all such story and they'll write it as what? 441 lakhs. Clear? This 441 they will write like that also. In exam you do whatever you want to do, but make sure whatever you're writing properly you're writing. Clear, Ama? This alone you take care, everything else will be in your control. That's why when you see most of the answers now, how they will present this goodwill 59 lakhs is cost of investment as on the date of acquisition 31st March, they'll say it as what? 500 lakhs. Instead of writing 441 directly, this much calculation they'll do. Cost of investment 500 lakhs less holding company share of net worth in subsidiary company as on the date of acquisition for 70%. This much they'll write total 441. They'll write the goodwill as 59 lakhs. So both the answers are correct. Next time when you see the ICA study material, something like this, now don't get heart attack and all. Easy only. This small thing they will do something and all. Clear? So do properly. Either of the way you follow, you'll get the marks. Clear? So goodwill comes to how much? 59 lakhs. So step number 2, goodwill or capital reserve, we have found goodwill is the case. So minority interest as on the date of acquisition is how much? 189. That also you have to show. Clear? So let me write calculation. Calculation of minority interest to be shown in consolidated balance sheet of holding company. Consolidated balance sheet as on what date? 31st March. Correct? Date of acquisition also what? 31st March. So on 31st March, how much these people are having? 189. On 31st March, how much? 189. So 189 I am showing it here. Clear? Clear? Then what we will do? Full consolidation we will do. So full consolidation means these two always holding and holding company. Minority interest as per step number 3. Non-current current liability, holding plus subsidiary 100%, holding plus subsidiary 100%. Here also holding plus subsidiary 100%. In this sum we are having goodwill 59 lakhs, total take up, holding and subsidiary 100%, 500 lakhs, total will be tallied automatically. Clear or not clear? Sir, in this sum there is a revaluation loss. So revaluation loss impact. This one also, when you are writing asset value, it should be at revised value. It should be at what value? Revised or revalued amount. Clear? What amount? Revalued. Don't take 600. Clear? Point number 2. Sir, if revaluation loss is there, I am able to understand, sir. So what we did in, when there is revaluation loss in net worth, in liability, if we are in net worth, what we did in liability side approach, we have subtracted from reserves and surplus because the journal entry is P&L account debit to PPE account. If liability approach is followed, P&L is considered. Okay, no sir, I am following asset side approach, sir. Then if you are following asset side approach to find net assets, net worth, okay, assets should be taken at revalued amount, decrease the asset value. Clear? As I thought. And in consolidated balance sheet, take the revalued amount. Clear? If there is revaluation loss, impact 1 will be there in net worth and it will be going to consolidated balance sheet. Clear? No sir, revaluation profit is there. Then what entry would have passed if there is revaluation profit? PP account debit to revaluation reserve account. Correct? Therefore, if you are taking finding net assets or net worth or equity of subsidiary company using liability side approach, add it to the reserves. Clear? No sir, asset side approach I am following, then increase the asset. In consolidated balance sheet, as usual, take what? Revalued amount. That increased value or this side decreased value. Anything. Here it is decreased value or increased value. We can call it as revalued amount. Clear? Hold on. Okay, just to note it down also. Clear? Okay, third sum is done. Clear? Able to understand everyone? Okay, I know. It will be very easy. You'll also love it. Slowly, in the same pace, I'll take you. Fourth question. Okay. Fourth question. Consolidated balance sheet. This time dates are not going to be same. Date of acquisition will be different. Date of balance sheet will be different. How to do? Now let's start the story. Okay. See, balance sheet of X Limited, Y Limited as on 31st March. Equity and liability, everything they have given. Okay. This also everything they have given. For 60%, how much we are giving? 800 lakhs we are giving. Clear? Additional information. What is the date of balance sheet given in the question? 31st March 2024. But acquisition happened on what date? 1st April 2024. If you put a timeline like this, okay, date of acquisition is on 1st April 23. Balance sheet given date as per the question is what? Given balance sheet date is 31st March 2024. They have given this balance sheet, but date of acquisition happened 1 year back, correct? Exactly 1 year back. Clear? So this time dates are different. So date of acquisition is 1st April. Date of balance sheet given in the question is 1 year later balance sheet, and they're asking consolidated balance sheet on what date only? 31st March only. Consolidation they're asking. What is the holding company's percentage? 60. Minority interest. Array MI means what? Minority interest. Clear? How much? 40%. So 40% we are writing. How to do the calculation? Simple. Listen to me as usual. Step number 2 is what? Calculation of goodwill or capital reserve as on the date of acquisition to be shown in consolidated balance sheet of holding company as on 31st March. Listen, goodwill or capital reserve, as I always say, on the date of acquisition, how many shares you are holding? For that, how much you paid? On that date, what is their net assets? In that, what is your share? Remember, whatever you are finding, that should be shown in consolidated balance sheet. Please don't change the terms. Okay, when I say something is there, something is there. Clear? Cost of investment of Y Limited as on the date of acquisition. That is on 1st April, 60%. How much we have invested as per the question? 800 lakhs. Clear? Cost of investment will be maintained at cost. Clear? Now, on the date, okay, on the date of acquisition, 1st April only after it, 1st April 2023, on the date of acquisition, first I want to know what is the net worth of subsidiary company. In that, our share we have to find, correct? So first we have to find their net worth. In that, our share we have to find. Shall we start, ma? Listen. What is the supplementary working data or name? I'll write heading name is. Heading what I'll write is calculation of net worth of subsidiary company as on the date of acquisition. That is acquisition date is 1st April 2023. Correct? Now my first question is, okay, whether we'll follow asset side approach or liability side approach, we'll get same answer. We'll follow liability side approach for ease, like, to complete it very quickly. Clear? Point number 1, let us go to equity share capital. See, to find the liability side approach, we need what? Equity share capital and reserves and surplus. Correct? This two, what date is required? First, on the date of acquisition, goodwill is required. Then we need on the date of acquisition, what is the net worth? In that, what is the share? So everything I need on what data? Date of acquisition. Goodwill also as on the date of acquisition. Therefore, net worth also as on the date of acquisition. To find the date of acquisition net worth, I also need equity share capital on 1st April only. I also need reserves and surplus of 1st April only. But we will go to the balance sheet and we will take immediately. What is the balance sheet value? Y Limited, subsidiary limited. Correct? Subsidiary limited. What is the equity share capital and reserves surplus? 1200. If you take like that, we have to stand in the middle of the sheet, because what date equity share capital and reserves surplus? It is 31st March. But we need equity and equity share capital on equity share capital and reserve surplus on what date? 1st April 2023. So you cannot take these values, because these values are as on what date? 31st March 2024. I need this date's value. What to do, sir? Go to the information. They would have given some hint. Clear? Now they are telling reserves and surplus of subsidiary company on the date of acquisition 1st April 2024 was 150 lakhs. Sir, but they did not give about equity share. Okay, opening balance sheet on the date of acquisition, reserves they have given. Happy, sir. But equity share capital data they did not give. What I have to do? What you have to assume is rational assumption. If there is no extra or additional data about equity share capital changes, it is assumed that in the beginning of the year also it used to be how much? Only 1000. So 31st March, if it is 31st March 24, if it is 1000, it is assumed that beginning of the year also we are having 1000 lakhs only. If there is any changes, they would have given no further issue, buyback, something they should have given. Nothing is there now. We'll assume it as what? 1000 only. Clear? So at the time of calculation, listen to me, Kana. Now, step number 1, what is that? DOA, 1st April, DOB, different dates. Okay, when dates are different, something I'm going to do, which I'm calling it as what? Pre and post. What is that? Pre and post. What is pre and post? I'll teach you. Listen. See, the balance sheet given in the question is 31st March, but we need to find on 1st April. Correct? Now, we need net worth as on what date? On the date of acquisition 1st April. For that we are taking up what approach? Liability side approach, equity and liability. Equity and that is equity, share capital and reserves and surplus, they have given 31st March, correct? So 1200 is on what date? 31st March, that is on the date of consolidation. But we need net assets on date of acquisition, first 1 year before date I need. So on the date of acquisition, or which we'll call it as pre-period, on the date of acquisition or before. On the date of acquisition, which we'll call it as pre. On the date of acquisition, 1 year later you are telling 200, but in the beginning of the year, how much as per the question they went? 150, correct? Clear, sir? In the closing 200, beginning we are having 150. So during the year, how much has increased? 50 has increased, correct? Okay. So after acquisition, post acquisition period, there is an increase of 50 lakhs. Clear? Okay. Closing equity share capital is 1000. They did not give any additional information. So it is assumed that in the beginning of the year also, how much we are having? 1000 lakhs only we are having. Clear, Ama? So data is pre-acquisition or date of acquisition, post-acquisition period. Okay. As on the balance sheet date 1000, this is 200. Therefore, in the beginning 150 means post-acquisition period 50, and this is assumed to be same. There is no change in the post-acquisition period. Point number 1. To find goodwill or capital reserve, we need what? Equity share capital and reserve surplus on what date? On the date of acquisition. On the date of acquisition, equity share capital reserves is what? 1150. Total 1150. So net worth on the date of acquisition is 1150. Clear, Ama? Clear? On the date of acquisition, subsidiary company's net worth is 1150. In this holding company is holding how much? 60%, correct? So our share should be 690. For 690, we are paying how much? 800 we are paying. So how much extra we are paying? 110 extra we are paying. That extra is called as goodwill. That extra is called as what, ma? Goodwill. Clear or not clear? Sir, what about this 40%? This is outsiders from minority interest. Sir, super, sir. Up to this, everything seems to be normal. Now, after we got control, a subsidiary company did the business. After doing a business, subsidiary is earned a profit of how much? 50. Plus is there, na? Plus 50 only, no? They earned a profit of 50 lakhs. My question is, that profit, correct, who should enjoy? We should enjoy 100%, or outsiders also are having share? Outsiders also having share. Therefore, post-acquisition period profit, in that 60% belongs to us. 40% belongs to outsiders. So 30 lakhs belongs to us, 20 lakhs belongs to outsiders. Clear? Why I am telling you, you will understand this. Clear? So step number 2, I will repeat once again. Okay. Cost of investment 60%. How much we are investing? 800 lakhs. Okay. What is the net worth of subsidiary company on the date of acquisition? We have to check. So what is the net worth we saw? 1150. In that 60% means how much? 690. For 690 we are paying 800. So we are paying more. Goodwill 110 lakhs. Clear? Clear? So with this is done. Correct? Sir, post acquisition period, whatever they are earning after acquisition. Sir, till now you did not say reserves and surplus of subsidiary we should not touch. But for the first time, whatever profits subsidiary company has earned, in that we are going to take, because after we acquire, on the date of acquisition, whatever reserves you are having, you cannot touch that, you cannot add it. For that, put together with equity share capital reserves, for that we are paying what are investment value. So this will be accounted indirectly in the name of goodwill or capital reserve. What about this 50 is? This also we have to show it in consolidated balance sheet. But our share of profit is only 60%. Minority is what? 40%. Clear? Correct? So this reserves will come to consolidated indirectly in the name of goodwill or capital. This we have to show separately. How to show separately? I'll tell you now. In this 50, 30 lakhs belongs to us, 20 lakhs belongs to the outsider. Therefore, step number 3 calculation is calculation of minority interest to be shown in consolidated balance sheet as on what date? 31st March 2024. But minority interest on the date of acquisition, how much they are having? 460 they are having. How many lakhs? 460. On the date of acquisition, okay? On the date of acquisition, how much we have to pay? 460. After acquiring, that company has earned a profit of 50. In that 50, they will get 40% share. Correct? So their share will be how much? 20. So total amount that belongs to outsider is how much? 480. This is what we have to show. So on the date of acquisition, post acquisition, total how much we have to show in the consolidated balance sheet we have to see. Clear? So minority interest share of net worth in subsidiary company as on the date of acquisition 460 plus minority interest share of post acquisition profit for the year after acquisition, that year how much is their share? Out of 50, 40%, 20. So minority interest to be shown in consolidated balance sheet is so much, 480 lakhs. Clear? Clear, ma? Now listen to me. Step number 4. Okay, step number 4. What is the step number 4 calculation we are going to write is calculation of consolidated reserves and surplus of holding company to be shown in what? Consolidated balance sheet. Listen, first I'll explain you the balance sheet, then I'll come to you. Actually, in balance sheet, shareholder fund, share capital of which company only will show? Share capital of our company, holding company alone will show. How much? 1000. Reserves and surplus also will show only how much? 600. Correct? But for the first time, we are not going to show 600 alone. We are not going to show 600 alone. This time what happened is after acquisition, there is a profit of 50 lakhs earned by the subsidiary which belongs to us. Entire 50 belongs to us. 60% only belongs to us. 60%. So this time not only holding or including, but also after our acquisition, using our money they earned profit. In that we should get the share. Before acquisition, whatever profits they are earning, we are not having any right against it. After we acquire, whatever profits they are earning, in that we are having share. Clear? Before acquisition, whatever resources surplus we are having control, we can have a share, we cannot have share. They will hit with stones. For that only you are paying investment value that much. Correct? So that will come to what? Consolidated balance sheet in the name of goodwill or capital. So after our acquisition, okay, before acquisition, pre-acquisition or on the date of acquisition, whatever reserves, that is not out of your money. So you cannot ask the share. That's why previous sums and all, I would have not taken subsidiary share because it is not our resource. They did not use our resources. Correct? But in this sum, I am taking what are reserves and surplus of subsidiaries. Only our share we are taking because using our money they earned. So it should be included in our reserves also, but not entire amount. Whatever is our share, we have to include it. Clear? So 600 plus 50% into 60%. 50 lakhs into what percent? 60%. So in this 630 we are going to show. Clear, Amma? So step number 4 is how much we have to show it consolidated balance sheet. Whatever is the holding company reserves and surplus as on the date of consolidation, take that as per our question as on the date of consolidation 31st March. How much we are having? 600 lakhs we are having. Correct, Amma? So 600 lakhs as on the consolidation date. How they will get is, okay, how they will get is holding company opening balance. During the year, holding company would have earned some amount. Put together closing balance of holding company will have. From that we have to add. With that we have to add what? Subsidiary company's profit. In that our share we have to add. So totally our reserves will increase by how much? Totally 30. So overall value which we have to show in what? Consolidated balance sheet is 630 lakhs. Clear? Before that and all we would have not taken this 30. Like, subsidiaries reserves and surplus, because up to that date because dates are same, no, so we post acquisition there is no profit, every date is same. In the sum, date of acquisition is 1 year back and consolidation is what? This date 31st March. So during that year after our acquisition, using our money they would have earned a profit. In that profit we have to take the share. Clear? That resource I am adding it. So total comes to 630. So remember, when dates are same, date of acquisition, date of balance sheet, dates are same, there is no concept of pre, that is date of acquisition, post story is not there. Correct? But when dates are not same, what is their date of acquisition? 1st April, date of balance sheet is what? 31st March. So you in the 1 year period after acquisition, after our acquisition, using our money, they are earning a profit or loss. In that we are having a share. We also will have outsiders minority interest also they will have. So total holding company's reserves and surplus as on 31st March is how much? 630, which we will call it as consolidated reserves and surplus, which will call it as what? Consolidated reserves and surplus of holding company to be shown in consolidated balance sheet. Clear? I am repeating once again, only when the dates are different, pre and post is there. Using our money, post acquiring, like post acquisition, using our money, whatever the profits or losses they are incurring, we have to consider. Profit means add, loss means subtract. Clear? So consolidated balance sheet, how much you have to show? 630. That's why I am writing it as 630. So make sure your steps are correct. Step 2, 3, 4, if it is correct, done. Clear? So holding company, holding plus our share of post acquisition share profit 630, minority interest as per step number 3, and after that line by line consolidation, include goodwill and get the values. Clear or not clear? Very very easy. Clear? Shall we proceed further? Let's go to 5th question. Okay, if you are having any thing, pause, just observe it, then do it once. Clear? 5th sum. balance sheet of what company? H Limited and S Limited as on 31st March. Okay, and investment in S Limited, how many shares? This time percentage they did not give, they have given what? Now in number of shares they have given. Clear? So we have invested for 40,000 shares, we have paid 7 lakhs. Investment in S Limited is on 1st October. Sir, always 1st April only will be investment, or 12 months back only, or any date is possible, any date is possible. Sir, date of acquisition 1st October, balance sheet date is what? 31st March. Dates are same or different? Are different. Correct? Then pre and post story will arise. Correct? Accordingly, we have to do pre and post story. Correct? And one more hint there. Equity shares of both the companies what? Rupees 10 each. Equity shares. So total share capital is 10 lakhs. Correct? In this, if each share is 10 rupees, means how many equity shares? 1 lakh equity shares in what? Holding company. But important is what? Subsidiary. If like each share is 10 rupees, how many shares it will be? 50,000 equity shares. Array, they are having 50,000 equity shares. In that, how much you are assuming that? Okay, sir, but this is on what date? 31st March. No, sir. Correct? If nothing is given in the additional information, if you read fully, they did not give any further issues there. Buyback is there, nothing they would have told. It is assumed that on the date of acquisition also they are having how many equity shares? 50,000. In 50,000 we are holding how much? 40,000. Correct? Therefore, how much is the degree of control we are having? 80% degree of control we are having. How much? 80% we are having. Okay, so always remember, holding company and subsidiary company, the degree of control how to find is on the date of acquisition how much we hold. Correct? On the date of acquisition what subsidiary company is having. Array, remember that clearly. In last sum when I am teaching, this point is very very important. Clear? And the date of acquisition is what? 1st October. Balance sheet date is 31st March. Dates are same or different? Different. Then whenever it is different, who will arise in the step number 2 supplementary working? Pre and post. Pre means on the date of acquisition, like that you remember, and post. Clear? Clear? But balance sheet what they have given in the question is 31st March. Post, correct? So balance sheet they have given in the sum is what? 31st March 24. Date of acquisition happens on 1st October, means 6 months back. Correct? Hello? So what we have to do, I will tell you. Listen, very important sum. After doing the sum, illustrate like ICA study material, there are 2 illustrations. Okay, before Virat and Anushka sum, there are 2 sums. Easily you can do. Clear? Very very easy. Go in the same sequence. Okay, listen. Reserves of subsidiary limited as on what date they are giving? 1st April they have given. Okay, see why they are telling is correct. First step 1 is completed. Step number 2 is what? I will tell you that step number 2 is calculation of goodwill or capital reserve as on the date of acquisition 1st October 2023 to be shown in consolidated balance sheet. For that we need 2 components. What are the 2 components? Cost of investment in subsidiary company as on 1st October. Correct? On that 80%, on that day we are having 80% control. For that, how much we are paying as per the question? For that 40,000 we are paying 7 lakhs. So first component is done. Next component is holding company share of net worth in subsidiary company on the date of acquisition 80%. For this we have to do the calculation. Correct? How many approaches are there? 2 approaches are there. Correct? Now my question is, when you find net worth of subsidiary company, we need as on the date of acquisition. What is the date of acquisition? 1st October. So we will draw a timeline. We need on this date what is the reserves value, P&L value, equity share capital value. Correct? This is what we need. Correct? To find net worth. To find what? Net worth. Correct? Point number 1. Okay, sir. When we create step number 2, what we will do? Equity and reserves and surplus will take. In the sum, reserves and surplus they did not give as reserves and surplus. The breakup of reserves and surplus they have given. Correct? So reserves surplus, reserves separately, P&L separately. Correct? Hello? 2 lakhs, 3 lakhs. Listen to me. Okay, listen. Okay. Equity share capital of which company? Subsidiary is what? 5 lakhs. Since no information is there, whatever is the balance sheet value they have given, it is assumed to be same on what? On the date of acquisition also. Same 5 lakhs only. It was existing 6 months before also will exist. Correct? We acquired on this date. After our acquisition 6 months passed. After 6 months these are the values. Clear? Point number 1. As per the balance sheet given in the question, what is the balance sheet date? 31st March. On the 31st March 2024. Okay. On 31st March 2024, what is the closing reserves and P&L value? Closing reserves and P&L value is how much? Okay. How much? 3 lakhs. Where is that? 3 lakhs and 2 lakhs, correct? 3 lakhs and what? 2 lakhs. Okay, they are telling, array, this is closing balance sheet date value, correct? But to find the net worth as on the date of acquisition, I need, this is closing value. If I want to find net worth on the date of acquisition, equity share capital also I need as on the date of acquisition, reserves and surplus also I need on the date of acquisition 1st October only. But whatever values you people have given is 31st March values. I need what value? 1st October. 6 months back, what was the reserves? Correct? Further, they should give no in additional information on 1st October, reserve value is this much. On 1st October, P&L value is this much. If they give it slightly, we will take. Correct? But we will go and see what is the additional information, whether they have given slightly, whether they are feeding you directly or indirectly they are feeding. We will see. Okay. So, with one hope you went to additional information and you are seeing reserves are S Limited as on 1st October. That is not there. That is not there. You should not feel sad. What, sir? 1st October, if they give it, would have been easy, no? Your CA students, correct? They did not give straightly 1st October. If they give 1st October, straightly that values you can take. But they did not give. They have given what values? 1st April, P&L balance is 150. Resource balance is 150. P&L balance as on 1st April is 2 lakhs. Sir, what, sir? 31st March balance sheet they have given, that I have taken. 1st April values they have given. I don't want this value, I don't want this value, I need this value only, correct? Then accountancy says, array, correct only, you need this value. But in some they have given this and this. That hint, using that hint you can find, what problem you are having. They are telling, array, okay, beginning of the year 150, 2 lakh. At the end of the year, 2 lakh and 3 lakh. Listen, reserves from 150, it has come to 2 lakhs. During a period of 1 year, there is an increase of how much? 150 has become 2 lakh means, during a period of 12 months, there is an increase of 50,000. Correct? Yes or no? Now they are telling, you need this value. How many months are there from opening to date of acquisition? Sir, 6 months, sir. Correct? Therefore, they are telling, okay. So, in 1 year period, 50,000 increase means 50,000 is for 1 year. Therefore, how much is for 6 months? Is 6 by 12. How much it will be? 25,000. So, if 50,000 is for full year, then 25,000 will be for first 6 months, 25,000 for the next post acquisition period. So, here 150. In the first 6 months, 25,000 increased. So, on the date of acquisition, reserve value is what? 150 plus 25, 175. Similarly, P&L balance opening is 2 lakh, closing is 3 lakh. So, during the period of 1 year, that is 12 months, how much increased? 1 lakh. So, take time proportionate basis. So, 1 year, 1 lakh increase means, what is the pre-acquisition period increase? 6 months. Here it is 6 months. So, in the sum, pre is 6 months, post is 6 months. Clear? Then what I will do, that 1 lakh increase P&L is there, no? I will divide by 6, like that is 1 lakh into 6 by 12, 1 lakh into 6 by 12. Therefore, 2 lakh in 1 lakh into 6 by 12 is how much? 50,000. So 2 lakh plus 50. How much it will be? On the date of acquisition, 250. Post acquisition, how much? 50. Clear or not clear? This is how you have to find what? Date of acquisition value. Clear? Sir, always 6 months, 1 year. Last time we did not do, no sir, like this. Yes, sir, last time they did. Acquisition date is not this, tightly this. Correct? So pre-acquisition period is 1st April. After this you acquired. Correct? Correct? So it will be what? 12 months. So last sum, the pre and post is what? 0 is to 12. Correct? That's why entire 50 lakhs or 50,000 you have taken for what? Post acquisition period. 50 lakh into 60% and 40%, you know, same like that only you should do. So last sum pre and post is there. Pre period is 0. Post is what? Because last sum date of acquisition also 1st April. Correct? And resource and P&L also that day they have given. So everything is post period only. So 0 is to 12. 0 is to what? 12. This sum, they have given opening reserves and P&L, but date of acquisition is this. Correct? So pre-period is 6 months. So post-period is 6 months. So accordingly, this 150 to 2 lakhs, 50,000 increase, 1 lakh increase should be divided in what ratio? 6 is to 6. Clear? I'll ask you one question. Listen, if date of acquisition is on 1st December, correct? Then this 50,000 should be divided in what ratio? 8 is to 4. Clear? Clear? This 1 lakh increase should be divided in what ratio? 8 is to 4. Clear? If date of acquisition is 1st January, then what is the ratio? 9:3. Accordingly, 9 for 9 months how much you add it and find for date of acquisition. For 9 months how much you add it, find the date of acquisition. Balance will be for post acquisition period. Clear? Therefore, how to find the reserves and surplus on the date of acquisition is they are telling array equity share capital whatever is the closing is assumed to be opening. Reserves and surplus also what date I need? 1st October I need. Here also I need for what? 1st October I need. Clear? Listen, but reserves they have given, closing they have given, opening they have given. Exactly I need for this. They are telling take the opening plus whatever is the increase during the pre-acquisition period added. Whatever is the increase in the pre-acquisition period added. Subtract means subtract. Add means add. Here it is increasing, that's why we are adding. So on the date of acquisition reserves and P&L 175, 250. But sir, out of 50, pre is 25. Correct? Then post how much? 25. Clear? Similarly, total 1 lakh sir. Pre is what? Pre or on the date of acquisition 50. Then for the next 6 months we are having 50. No, so that 50 you write it in the post acquisition period. Clear? So listen, calculation of net worth of subsidiary company as on the date of acquisition 1st October. So that date of acquisition is called as what? Pre. Okay, equity share capital is assumed to be same. Okay, closing balance is 2 lakh, but they have given what? Opening 1 lakh 50. So during that 6 months 25 you are adding, you are writing it as 175, balance 25 in the post column. Similarly for P&L also. Clear? Everyone able to understand up to this? Simple. After this what we have to do is just check what are the other adjustments we are having. Clear? And last point, this many students commit mistake. I will tell you how to do it rightly. Class also I would have alerted you many times. PP of S Limited revalued at how many lakhs? 12 lakhs. On what date they revalue? On the date of acquisition only they will revalue. Depreciation provided. They did not say to be provided. Clear? Depreciation to be provided they did not say. Provided means already they have charged depreciation on PP at what percentage? 10%. So first go to S Limited's PP value. Go to S Limited's PP value. What is the PP value of S Limited? 9 lakhs. Correct? This they have revalued. They have. It is to be revalued at what amount? 12 lakhs. On what date they are revaluing is on the date of acquisition 1st October. What is that? 1st October they are revaluing. Correct? But whether they have revalued, see when they give it as an adjustment, it means they did not revalue. We have to do the impact. They will don't expect revaluation effect is not given in the balance sheet. Don't expect that lines. If they give like that, it means it is implied that they did not give the revaluation impact. Clear? Correct? Sir, okay. Know what we have to do, sir? Array simple. You remember revaluation profit, what and all we have done in the previous sum where dates are same. Here's the same impact, but dates are different. Shall I teach you what students commit mistake, what you should not commit as a mistake, what you have to do rightly? I will tell you. Listen, ma. Now, actually, for net worth, for calculation of what ma? Net worth, we are doing one supplementary working pre and post. Correct? Now for revaluation, effect of revaluation reserves and surplus of subsidiary company I am going to teach you. Listen, what they have done, what we should have done. Clear? Listen, after see in the PP in the balance sheet 31st March 2024, what is the PP value? 9 lakhs. This is what depreciation provided, means after providing depreciation for 1 year, the value of PP shown in the balance sheet is what? 9 lakhs. Therefore, the balance sheet value PP as on the balance sheet date given in the question 31st March is 9 lakhs, which is after providing depreciation of 10%. Means that 9 lakh is what? After depreciation or before depreciation? After depreciation. Depreciation percentage is how much? 10% for year per annum. Therefore, this represents what? 90% only. Listen, if after charging 1 year depreciation, if it is appearing 9 lakh, then before 1 year, how much it will be for 100%? Correct? So 9 lakh, if it is representing 90%, then for 100%, how much? 10 lakhs. Clear? Clear? My question is whether they are revaluing on 1st April itself or on the date of acquisition they are revaluing. That you have to check. Clear? Sir, on 1st April revaluation means 12 lakh I will write here. Correct? Array, yes or no? But revaluation happens on 1st April or on 1st October on the date of acquisition. On 1st October on the date of acquisition. Therefore, they are telling Appo first 6 months you charge depreciation. How to charge depreciation? 10 lakh into 10% into 6 by 12. How much? 50,000. So PP value on the date of acquisition 1st October is how much? 950. On this date only they are revaluing to 12 lakhs. Clear ama? So 950 and that day revaluation amount. Okay va? The amount of asset is 12 lakh. Therefore, how much is the revaluation increase? Is 2,50,000 is the revaluation increase. Majority students, what mistakes they are committing? No, they are not seeing this revaluation data as 1st October. They are seeing as, okay, what before depreciation, what is the PP value? 10 lakhs. That is revalued to how much? 12 lakhs. Correct. Therefore, they are writing it as revaluation profit as 2 lakhs. That is wrong. You have to check on what date the date of acquisition. Generally on the date of acquisition only they will take the revaluation value. Clear? Revalued amount. So had the date of acquisition is on 1st April, instead of this, add the date of acquisition is this, then that day you can compare with 12 lakhs. Then you can write what? 2 lakhs. Then what entry you would have passed? PP account debit to revaluation reserve. So revaluation reserve, if it is liability approach, you would have added to net worth. Correct? But in the sum, date of acquisition is not on the 1st April 23. So it is on 1st October. So first to find on the date of acquisition 1st October, what is the carrying amount of PP? That is revalued to 12 lakhs. The revaluation is 2,50,000. Profit, revaluation profit is how much? 2,50,000. Don't compare with 10 lakhs because that is not the date of revaluation. Clear? So revaluation profit is not 2 lakhs. It is 2,50,000. Clear? So you remember 2,50,000. What we'll do on the date of acquisition? There is a revaluation profit. What entry these people should have passed for revaluation profit? PP account debit to revaluation reserve account 2,50,000. This happens on what date? Date of acquisition. That's why if you go to that step number 2, on the date of acquisition, since these people have not given the impact of revaluation profit, I am just writing in which column itself? Revaluation profit itself. Clear? So 2,50,000 I am adding because it is profit. One more twist is there. Correct? Unlike the previous revaluation profit loss sum, there all dates are same. Here dates are different. So when dates are different and revaluation impact is there, depreciation also will change. How we have to account it, I will tell you. Listen to me. See, what they have done is 10 lakh they have brought to how much? 9 lakh. Therefore in the year, how much for 12 months period they have reduced? 1 lakh they have reduced. Correct? How much they have reduced? 1 lakh. That's why 9 lakh is appearing in the balance sheet. But my question is, 10 lakh has become 9 lakhs, means how much depreciation they have actually charged? 1 lakh. But right, depreciation is 1 lakh, something else, something else. What is the something else? Is they are telling, array, actually next 6 months, first 6 months 50,000, that is agreed. Clear? But next 6 months, you remember AS10 prospective basis we have to give the impact. Next 6 months depreciation should be on the revised value. So 12 lakhs into 10% into 6 by 12, the depreciation should have been how much? 60,000. But how much only these people are charging is first 50, next 50. Correct? Actual should be first 50, then 12, in the depreciation 60. Correct? So actual depreciation should have been how much? It should be 1,10,000. That is first 6 months 50,000. Next 6 months it is not 50. Revaluation happened. Therefore it is 60,000. Correct? 50 plus 60, 110. But they have subtracted only 1 lakh. We should have subtracted 110. So still extra how much we have to subtract? 110 itself we will subtract. 10 only we will subtract. Only 10,000 extra depreciation we have to charge. Correct? What is the journal entry for depreciation? This happens in whose books? Subsidiary books. Correct? Because their net worth only, no. So they should have passed depreciation, that is P&L account debit to PP account. Correct? How much? 10,000 and 10,000 depreciation entry. Correct? Therefore, since we are in liability side approach, P&L is debited. P&L debited means decrease. Sir, whether we have to write in pre or post, depreciation when you will charge beginning, date of end of the end. That's why it is coming under the post column. Clear? Therefore, extra depreciation we have to charge, because of which P&L should decrease. Correct? So I am decreasing the P&L. P&L decrease means minus. Clear? So always remember, when the revaluation profit is there, there will be additional depreciation. There will be what? additional depreciation. If there is revaluation loss means what they would have done, they would have if there is revaluation loss means, for example, instead of 12 lakh, assume it is coming to 5 lakhs, then depreciation will be less, but they would have charged more, correct? They would have charged more, actually we should charge less, so extra depreciation will be there, no, that we have to reverse back, so what is the entry will pass? P&L should be increased, P&L should be added. Correct? Therefore, listen the crux. Revaluation profit means additional depreciation subtracted. If there is revaluation loss means they would have charged more depreciation. So add back to the P&L. Clear? Akana? Hello? That also I will show you in the note which you can copy down. Clear? Ama? Listen to me. Okay. So revaluation profit is there. Considering that we are having extra depreciation, additional depreciation, okay, that additional depreciation we have to charge 10,000 will charge. Clear? Ama? 10,000 you subtract. Now if you consider this on the date of acquisition, equity, reserves and surplus, after all the adjustment, what is the value? 11,75,000. In that, what is holding company share? 80%. Minority is what? 20%. Clear? Post acquisition, how much we are having? 25, 50 and 10. Total comes to 65. Entire post acquisition we should enjoy, or minority will also enjoy. Minority will also enjoy 80%, 20%. This will go to step number 2. Minority interest will go to what? Step number 3. You remember? On the date of acquisition plus post acquisition, step number 3. Okay, now this I will be taking it to what? Our share of post acquisition should be taken to step number 4 for consolidated resources surplus. So in exam also, when you do quickly after getting the clarity, immediately have to do in exam, speed and consistency, full clarity. Okay, consciousness should be very high. So make sure you are doing it clearly. Okay, step 2, 3, 4, 3, 2, 3, 4, 3, 2, 3, 4, 3. Clear? Step number 2. First we will find what? Goodwill or capital reserve. Correct? For 80%. We will take, so let's find goodwill or capital reserve. So for 80%, 7 lakhs we invested. What is our share of net assets? 9,40,000. For 940 we are paying only 7 lakhs. Therefore there is a profit. Capital reserve 240, which should be shown in what? Reserves and surplus. Clear? Step 2 is done. Step 3 is what? Calculation of minority interest to be shown in consolidated balance sheet. On the date of acquisition, what is their value? 235. Post acquisition, what is the profit? 13. So total comes to 248. So total minority interest comes to what? Minority interest share of net worth in subsidiary company 235. Post acquisition 30. So total comes to 2,48,000. This we have to show it in consolidated balance sheet. Step number 4, consolidated reserves and surplus. Okay, listen, how to do it very cleanly I will tell you. First, holding company value as on the date of balance sheet, then post acquisition share. Go to the balance sheet and check what is the holding company's value we are having. Holding company's value, how much we are having? 5 lakhs and 7 lakhs. Take that value first. Clear? So 5 lakhs and 7 lakhs. Capital reserve balance holding they did not have. If you are having, take that also. Post acquisition share of reserves, post acquisition share of P&L. Listen to me, how to do I'll tell you. Sir, post acquisition share totally 25, sir. In that our share is 80%. So 80% means 20, and P&L 50 minus 10, total is 40. In that 80% is how much? 32,000. Therefore, post acquisition share in the reserve is 20,000. Post acquisition P&L 40. In that our share is 80%, 32,000. So I'll write only our share of reserves and P&L. And the date of acquisition we got as per step number 2, 240. Therefore, what is the consolidated reserves and surplus of holding company to be shown in CBS is total 520, 732, 240. Clear? So if you go to share capital, write only holding company share capital. Clear? Always remember share capital, reserves and surplus, okay, and investment of what holding company should be nullified. Post acquisition reserves only you have to show. So 10 lakh only holding company, reserves and surplus as per which step? Step number 4, 520, 732, 240. Minority interest as per step number 3. This line by line consolidation 10 and 3. How did we get 10 and 3? I'll show you. Non-current liability. Listen, 6 plus 4, 10. 2 plus 1, 3. Like that line by line consolidation if you do, automatically you'll get the answers tallied. Clear or not clear? Everybody, this is easiest. Clear? That revaluation part alone, take care of that. Practice 1 or 2 times to get the flow. Clear? Now we will go to certain adjustments. Okay, adjustments also I will teach you. Accordingly you can do. Virat and Anushka sum is also very easy. Virat holds 80% equity shares in Anushka Limited. Only difference, what is the difference in the sum is, okay, date of acquisition they would have given on the data from the incorporation date. He means beginning itself. Okay, beginning itself when Anushka Limited started, that time itself 80% we are acquiring. Clear? Means some years back we have acquired it. Clear? This is ICA sum. Okay. Okay, see, on the date of incorporation itself, they have issued share. That time itself, we got 80%. It is not like we are purchasing from outsider now only. Clear? So from that date, we are holding what? 80% in the Anushka Limited. Clear? See, the difference, only difference is in this sum. Okay. How much is the investment value is 3,20,000. What is the investment value, ma? 3,20,000. How many equity shares Anushka Limited is having is 40,000 into 10. That is 4 lakhs. In 4 lakhs, how much we are holding? 80%. So 4 lakh into 80% is what? 320. For 320 we are also paying how much? 320 only. Correct? So is there any goodwill or capital reserve? No goodwill or capital reserve. Listen, what is that? No goodwill or capital reserve, because we are holding from the beginning. So that we are writing it as what? The 4 lakh into 80% is how much? 320. We are also investing 320. So therefore there is no goodwill or capital reserve. Whatever profits they are giving in the question. Okay. Listen to the, look at the sum. And if you look into the reserves and surplus, 1 lakh. Okay. Reserves and surplus of Anushka is what? 1 lakh. Everything is what? Post, because on the date of acquisition itself, when they are incorporating itself, we gave the capital. Means first day itself they are having our amount. So whatever profit they are earning from first day, everything what belongs to us also, means our share belongs to us. Therefore, the reserves is how much? 1 lakh. Correct? Whether it is called as pre-acquisition or post-acquisition, because first day itself we have also invested. When they are incorporating, that time itself we got. So whatever profits from day one they are earning, for us also it is having, we are having the share. So 1 lakh is there. In that our share is 80%. So that's why if you go and see the reserves and surplus calculation, in the 1 lakh, whatever is the, in the general reserve of 1 lakh, how much is the parent's share? 80%. So post-acquisition I'll rate it as 80,000. Because everything is post period only. There is nothing called as pre period, because when they are starting the business itself, we purchased so there is nothing called as pre, because they themselves they are not there. Correct? So when they started, we invested, so everything is called as post. So our share is out of 1 lakh, 80% we have to take. So 80,000 is the share. Accordingly, you do the balancing, everything will be in its place. Same line by line consolidation, holding and subsidiary. Clear? Equity share capital only holdings. Reserves here we will take what? Holding as well as post-acquisition share. Same rules you follow, line by line consolidation, you get the same answer. Now, certain adjustment I will teach you. Intercompany adjustments. What company? Same thing I taught you in amalgamation. Revision class was there, uploaded in YouTube channel of KS Academy. Please see that same content only will be there. Okay, for intercompany adjustment. Sir, already we have purchased something or sold something, sir. There is intercompany adjustment. Accountancy sees, for you would have sold. You will be showing that fellow as what? Debtor. And that fellow, he will be showing as what? Creditor. When you consolidate, correct? When you consolidate, what happens? In your books, you are showing as debtor. When you consolidate, okay, in his books, it will be like sundry creditors. Assume 10 lakhs and 10 lakhs. Okay. When you consolidate, what happens? Sundry creditors of that company also will bring, correct? Correct? So what happens? Within the same balance sheet, opposite side, they'll be looking, hey, you give, hey, I'll pay, like that. You cannot pay to yourself, you cannot receive from yourself. Correct? That's why accountants say, as if this transactions has not happened, show the reality. Okay, show the reality. We have to show only that which is liable to be paid or received from the outsiders. Within the company, you should show, sir, I should pay to my company, I should receive from my company, that and all you should not do. If that is allowed by AS21, no, people will show whatever they want to do. Full manipulations are possible. Correct? That's why, as if these transactions are not taken place, I want to show only that which is receivable and payable to the outsiders, not within the group. Clear? If that allows, everyone will do whatever they want to do. Correct? Chumma they will pass what? Credit sales entry. Correct? Sales they will boost, data they will increase, creditors they will increase. That is not correct. So eliminate what? Intra-group transactions. We have to eliminate what? Intra-group transaction, as how you do for amalgamation also. What entry will pass? Creditors account debit to debtors account. Then only this creditor will be eliminated, debtor will be eliminated. Same with the case of what? Bills receivable and bills payable also. Eliminate bills receivable and bills payable also. Clear? So, sir, for example, assume, sir, in our books, debtors. In their books, there is creditors. 1 lakh means easy to pass the entry. What does that say? What we have mutually, that only you have to eliminate, not everything. What is with the outsider, you have to leave it. Clear? What is between you? For example, in 1 lakh, with the holding company, if it is 50,000, and with the subsidiary company also 50,000 means you should not eliminate entire 1 lakh and 1 lakh. You should eliminate only what are mutual owings, how much? 50. That only should be eliminated. That only should be eliminated. Don't forget, don't eliminate everything. Clear, sir? Okay, assume, sir, I am having 1 lakh debtors, holding, correct? One second. Holding company is having debtor of 1 lakh, subsidiary is having creditor of 1 lakh. If this is there, we will pass sundry creditors to sundry debtors, but you are telling no, they are not required, sir. There is no separate set of books. The impact we have to show. That's it. Eliminate that also. So we will cancel, and in consolidated balance sheet, we will not show our what is receivable from us, what is payable to us. We will not show. Correct? But sir, if something is like this, for example, instead of 1 lakh, okay, instead of 1 lakh, assume it is 70,000 only, sir. Correct? Entirely holding company, entirely subsidiary company. Sir, is this possible? Possible, right? If this is the case, what we have to do is, we have to bring everything to same values. You have to bring everything to same values, then only you should eliminate. You cannot eliminate just like that. It should be same value to eliminate. In accountancy says, if amounts are not same, then it is treated as either cash in transit or goods in transit. It is assumed that, sir, subsidiary company has done everything rightly, sir. Holding company only they have to do. It is assumed that subsidiary company has made one payment. Assume they have given check. Check is in processing. Check is about to reach you. Correct? So once the check is received, once they are also depositing, these people will pass one entry, bank account debit to what? Sundry debtors account. That entry they will pass to the extent of 30,000. Correct? Then what happens? It will be reduced to sundry debtors. I will also show as 70,000. But I did not receive now, sir. Correct? Correct. The moment subsidiary company has given the check, they pass the entry, they reduce the creditor. Still, who has to receive? Debtors has to receive. Sometimes what happens, debtors would have received. They would have kept in the, like, locker, some bureau or any desk they would have kept. Correct. Accountant says, pass the entry. Whether you received or not received, that fellow has given. Correct. From his side, his work is done. You do one thing. You pass one entry. Cash in transit account debit to what? Debtors account 30,000. After passing, bring it to 70. Then you can eliminate. Clear? Clear or not clear? Sir, if this fellow is default, cash in transit to debtors, what happens if this fellow is the default, sir? Amounts are same. Holding company say, hey, 1 lakh only, what problem? He also received 1 lakh. Correct? Then we are going and asking subsidiary company, why you're showing only 70,000, 1 lakh he is telling, sir. I think he sent to goods, sir. He would have raised the invoice, he passed the entry. I am yet to receive, sir. Correct? Then they are telling, then for you it's goods in transit. Then pass one entry, goods in transit account debit to what? Creditors account you have to pass. Other than this, if anything is there, they have to give in the question. Some error done means that error they have to give in the question to pass the rectification entry. If they don't say or tell anything, if there is a difference, it is treated as what? Cash in transit or goods in transit. Clear? What entries we have to pass? Cash in transit account debit to trade receivables. If goods in transit means goods in transit account debit to trade payables. Same entry. Clear? What is that? Debtors account should be eliminated. Creditors account should be eliminated. If you want to pass any notional entry, what is the entry? Debtors account should be credited, creditors account should be debited to cancel it. Same is the case for bills receivable, bills payable. Mutually, whatever is the value, that should be cancelled. Sir, in amalgamation also you set this point, no sir, if bills receivable, bills payable amounts are not same, it means what would have happened? The person who is having bills receivable, he would have discounted with the bank or endorsed with the bank, correct? Leaving that mutually, whatever is the amount, that should be cancelled in the consolidated balance sheet. So what bills we have to cancel is what we should cancel, what we should eliminate is whatever that is not discounted with the bank, which is with us, whatever is not endorsed to others, which is with us, which is common to holding and subsidiary, that alone should be cancelled. Clear? So when it comes to bills receivable, bills payable, intercompany bills, they are telling intercompany bills to the extent not discounted, not endorsed, should alone be eliminated. Whatever I discounted and endorsed to some other person means it is actual liability, outside is liability. Correct? That should not be eliminated. That I have to show. Please don't do that particular elimination. What is not discounted, what is not endorsed, which is with us, that you can cancel mutually, whatever is between you and the subsidiary. Clear? That alone should be done. If it is discounted with bank, it becomes actual liability. Don't cancel or eliminate. If it is endorsed to some other person, it has become actual liability to the outsider. Don't eliminate it. What is between you, what is with you people only, that should be eliminated. Clear? And most importantly, next, unrealized profit in stock. Unrealized profit in what? Stock. Sometimes what happens? One company will sell to other company. cost plus profit they'll sell. Okay, if this is fully sold by the other company, no problem. Sometimes they'll not sell, it will be in the closing stock. Then what we have to do, this profit which is included in the closing stock should be eliminated. That we'll call it as unrealized profit, which we have to eliminate. For that we have to see which company has sold to whom. Holding company, if they are selling to their subsidiary, to the person below that, that is called as downstream. That is called as what? Downstream. Clear? So if holding company supplies sends the goods to the subsidiary company at a profit, then what we have to do? For example, holding company is having a goods costing 8,000 kada, they add cost plus profit, they sold to subsidiary for how much? 10,000. Okay, assume after selling entire subsidiaries entire goods were unsold, everything entire 10,000 is there in the closing stock of what? Subsidiary, nothing is sold. What we will do is, in consolidated balance sheet they are telling, oh you are holding company, goods costing 8,000, you are selling it for 10,000, therefore there is a profit included in how much? Holding company P&L 2,000 you have included. Correct? Point number one, what they are telling is, if entire goods is sold, no problem, because it is realized. But assume entire goods of 10,000 is lying in the subsidiary company stock. What in consolidated balance sheet we will do? Line by line consolidation, closing stock of holding a subsidiary 10,000 also you will add. Correct? 10,000 if you add, assume we are having 1 lakh, that 10,000 is also added, so it is 110. Now you are preparing consolidated balance sheet as a group, as a single entity you are passing. Correct? Actually you and me pretty well know, my stock is, we are having already stock which we bought from outsiders 1 lakh, and our stock value only we are bringing 8,000 we have to show, but you are bringing at what value? 10,000. Correct? Now accountancy says, your stock 10,000, his stock also you are including in separate financial statement, you can show it as 10,000, but when I consolidate, when I see as a whole, I'll see that also as my stock. No, my stock value is 8,000 or 10,000. 8,000 only, but you are showing at what? 10,000. Means you are overstating. That extra is how much? 2,000. That is profit. Realized or unrealized? Unrealized. Why, sir? Because I did not sell. If I sell, it would have been realized. Till I sell it, it is unrealized only. So accountancy says, now as on today, the 2,000 is what? Unrealized. Subtract that and show as only how much? 1,08,000. That is show only 8,000. Clear or not clear? Everyone. So only 1,08,000 we have to show. Correct, sir? Correct, sir. But in stock we have reduced to 2,000. But this fellow, when they sold, what he would have done? He would have included the profit in the P&L. Correct? Therefore, accountancy says, correct, accountancy says, when you are preparing step number 4, in step number 4 you remember a holding company plus post acquisition share. From that also you subtract 2,000, because when you sell, the 2,000 is included in P&L of what? Holding company. Now they are telling that is unrealized. You cannot show unrealized profit and all in the balance sheets. Clear? It is a misleading information if you do like that. So accountancy says, subtract the unrealized profit. Okay, don't subtract entire 10,000. Subtract only the profit portion. Clear? Profit portion only you have to subtract. So only profit we are subtracting, so that closing stock will appear at cost. Correct? As per AS2 principles. Correct? Then in holding company profit also 2,000 realized, unrealized. So bring it to how much alone? Realized. Clear? Clear? This is called as what? When holding is selling to subsidiary, that is called as downstream. When it comes to downstream, how to remove the unrealized profit? Unrealized profit, how they are telling us, subtract the full unrealized profit from stock. After adding, subtract it. Similarly, in step number 4, subtract the unrealized profit. Sir, no, sir. Sometimes what happens? Subsidiary, he will sell to the one at the top holding company. That is called as upstream. Then you tell me, in whose profit it will be included? Subsidiary's profit. In whose closing stock it will be there? Holding company closing stock. So holding company closing stock includes the stock sold by what? Subsidiary company, which includes unrealized profit also. Then they are telling, okay, you are having 10,000, but only 8,000. No, correct? Now they are telling, subtract that 2,000. So that if you subtract, it will become what? 8,000, and whatever is the subsidiary value that you have to add and to put together you can show. Clear? Clear? For example, assume we are having 10,000. Okay, this fellow is having 50,000. You cannot show the closing stock at 60,000 because this is actually 8,000 plus 2,000 rupees. So we have to eliminate this 2,000, subtract 2,000 and bring it to 58,000. Clear? Now, okay, sir, this is stock we have reduced, but subsidiary they would have included in the profit. No, sir, correct? They would have included in the profit, but that profit is included means we would have taken for net worth calculation. No, correct? Correct? Now they are telling, whenever subsidiaries P&L reserve is touched now, two people will be affected. One is V, other one is minority interest. One is V, other one is minority interest. Now accountancy says, oh, the 2000 was included in P&L of what? Subsidiary. Yeah. You remember when we prepare what? Step number 2, whatever is the equity P&L, that will be shared between what? Holding company and what company? Minority interest. So holding company, we will take it to what? Step number, most of the times it will happen post acquisition, correct? So that value, whatever is the 2000 is unrealized, that will be taken to minority interest as well as what? Holding company, minority interest and holding company. Then they are telling, array, already what you would have done? Okay, step number 4, what you would have done? 2000. Actually, step number 2 is what? Step number 4 is what? P&L of holding post acquisition share. But in the share, they would have included 2000 also, correct? 2000 into their share. Then they are telling, array, the 2000 in that, okay, whatever profit of post acquisition in the 2000 is unrealized. So subtract that 2000, entire 2000 only holding company share. In 2000 unrealized profit of subsidiary, only our share should be subtracted. So what about minority? Same, step number 3. Minority you are getting, no, minority on the date of acquisition plus post acquisition, you are getting one value, no. From that value subtract minority interest share of that unrealized profit. For example, 20% means 2000 into 20%, whatever is the amount is there, subtract and show the final number in the consolidated P&L. So when subsidiaries P&L is affected, clear? When subsidiaries P&L is affected, make sure you are giving impact in step 4 as well as what? Step number 3. Clear? Accordingly you have to do. Hello, will you remember? Okay, so upstream, downstream. Okay, downstream means subtract from what? After adding just a full unrealized profit, full unrealized, not full stock, unrealized profit, full unrealized profit. Similarly, in step number 4, full unrealized profit should be subtracted because holding company has sold. Correct? No, sir, subsidiary has sold to holding company. Then same step. Here, this fellow is same. But when it comes to this fellow, no, they are telling, that unrealized profit that is included in P&L was shared between what? Holding company and subsidiary. Okay, holding company and minority interest. Holding company, step number 4, you subtract their share. Minority interest, you subtract in step number 3, their share. Then only they'll get correct profits. Clear or not clear? These are all notional entries which we have to pass, not required in exams also. Clear? Clear? Then last most important one, consolidated with what? Bonus and dividend adjustments. Bonus and what adjustment? Dividend adjustments. Clear? Now, bonus and dividend adjustments, quickly I will take you guys through that. Listen, ma. Listen. See, all the balance sheets, the values they have given. H Limited, S Limited. What is the date of balance sheet is 31st March 2024 is the balance sheet date given. Okay. Investment in S Limited, how many shares? 30,000 shares. Okay. Investment in S Limited was made on 1st April 2023. But balance sheet date given is what? 24. 1 year before we have acquired. So 1 year before 0 is to 12 pre and post. Clear? Equity shares of both the companies 10. Okay. They are telling, listen, equity shares of both the companies 10 means it should be 80,000 shares. This should be 1 lakh shares. Correct? Out of 80,000 shares, we are holding only 30,000. Sir, then we are holding less than that. There is no control. Then AS21 does not apply. Or not like that. Wait, I told you no. Full question you read sometimes. Okay. Now reserves of S Limited as on the opening balance sheet or opening date they have given. Reserves P&L opening date they have given. Clear, Amma? Now listen to me. 4th point. See, this is opening values. This is what values? Opening value. 4th point. On 1st June, S Limited declared and paid dividend at what percentage? 20%. At what percentage? 20% for the year 22-23. Clear? For the last year, the current year, they are paying the dividend. At what percentage? 20% they are paying. H Limited wrongly credited its share of dividend in its P&L account. Clear? See, actually, for last year, if you are receiving current year, you have to see whether it is your dividend or someone else dividend. Okay, sir, when are you acquiring? 1st April only. Correct? Means which year you acquired? 23-24. But you are receiving dividend for which year? 22-23. Correct? Our current year is date of acquisition. Current year is what? 23-24. But you are receiving dividend for which year? 22-23. You are receiving a dividend for those shares for which you are not the owner in the previous year. Correct? Previous year you are not the owner, someone else is the owner. Since you are getting the acquisition, since you are getting the control and date of acquisition falls in the current year, dividend is given for you. Correct? Then accountancy says, oh, last year you are not owner, this year you got the control, immediately you are getting dividend for the previous year. Actually, someone else would have got. You are enjoying it. That type of dividends we'll call it as what? As per AS13. You remember AS13 you would have learned a pre-acquisition dividend. Actually, the journal entry for pre-acquisition dividend is bank account debit to investment account. Correct? But what they have done is, instead of crediting investment account, these people have wrongly credited P&L account. So instead of bank to investment, they have passed what? Bank account debit to P&L, which is absolutely wrong. Which is what? Absolutely wrong. One thing they have done rightly, bank they have debited rightly. If bank is also wrong, they would have told. Clear? Bank they would have done rightly, because people will be so keen in bank and BRS and all they'll get the value. But what they have committed mistake is, instead of doing this, they have done this, which is right or wrong? Wrong. Now we have to pass one rectification entry. Correct? Rectification entry is reverse this P&L credit. So P&L to reverse, debit that, and what should be credited rightly? Investment. So therefore the entry is P&L account debit to investment account. Clear? This is the rectification entry, and who is declaring? Subsidiary is declaring, and we are receiving. H Limited is receiving. Correct? So whatever is the dividend amount into H Limited share should be the amount which we have to debit and credit. Clear? This rectification entry we have to pass in what? Step number 2 and step number 4. Why, sir? Correct? Why, sir? Step number 4 we are able to understand, because P&L, sir, H Limited has committed the mistake. So H Limited in their books they have to pass the journal entry. So P&L of H Limited means consolidated P&L. Step number 4. Why step number 2? Investment is reduced. No, cost of investment is credited. Your investment values 5 lakhs. Correct? Now investment should be decreased, because we are crediting investment. So step number 2 we have to do. So this is step number 2. This is step number 4 adjustment. Value only we have to remember. Clear? And more importantly, okay, this is happening on 1st June. After 1st June, okay, June, July, August, September, October. Okay, so after 4 months, okay, what is happening is, S Limited issued bonus in the ratio of what? 3:5. What is the meaning of 3:5? Is, if you are holding 5 shares, I'll give you 3 shares are bonus. Totally, for example, you are having 5 shares. I am the company. I am giving 3 shares. At the end of the year, how many shares you will have? 8 shares you will have. Sir, in the beginning of the year, assume you are having 50. I will give you how many shares? 30 shares as a bonus. Correct? Because for every 5 shares, 3 shares if I give. For 50 shares, if you are holding, I will give you how many shares? 30. At the end of the year, how many shares you will have? 80 shares you'll have. For example, in the beginning of the year, you are having 5,000 shares. Clear? And I am telling, for every 3 shares, I am going to give, for every 5 shares, I am going to give 3 shares as bonus. So how many bonus shares I will give you? 3,000 shares. In the end of the year, how many shares you'll have? 8,000 shares. For me, the issuing company, it is loss. Bonus is loss to the issuing company. The person who is getting it is can be treated like a profit, but you will not pass any entry for that. Clear? So this is at the end of the year. Clear? My question is, what is the date of balance sheet given in the question? 31st March, which is end balance sheet. As at the end of the year, S Limited is having how many equity shares? 80,000 equity shares. Therefore, at the end of the year, if you are having 80,000 equity shares, at the beginning of the year, before bonus, how much these people will have? 50,000. This will be the date of acquisitions shares, post which these people are issuing on what? On 1st October. On 1st October only you are issuing bonus. Before bonus and all, then you should have had how much? 50. Then bonus would have been 30. Then only closing 31st March, whatever is the balance sheet date they have given, 80,000. Correct? My question is, to find the degree of control, we have to focus on what? Date of acquisition. You remember one time I said, this date of acquisition is very, very important. On the date of acquisition, how many shares? 50,000 shares. Correct? So on the date of acquisition, 50,000 shares. In that 50,000 shares, we are holding 30%. So to find degree of control, we have to see on the date of acquisition, what is the number of shares they are having and how many number of shares we are holding, how much it is, into 100 if you do 60%. Clear or not clear? Everyone, even after acquisition also, if you calculate, you will get the same answer. Sir, if you take 80,000, that time also 80,000 at the end, then you have to see in the beginning if you are holding 30. Correct? In the beginning if you are holding what? 30, you would have also received a bonus. Correct? What is the bonus ratio? Whatever shares you are having, for every 5 shares you will get how much? 3 shares as bonus. Correct? So assume 6,000 plus 6,000 into 3 is what? 18. So at the end of the year, beginning on acquisition 30, you are also getting bonus. So totally how many? 48,000 out of 80. What ratio? Same 60% only you will get. Clear? But degree of control, make sure you are finding on the date of acquisition, same percentage only you will get. 480 into 8 lakhs, 80. 48 into 48 divided by 80 you do, you'll get the same number. Clear? So 60%. 60% means control. So AS21 consolidation we have to do. Clear? Don't compare that 30,000. If this is on the date of acquisition, it should also be on the date of acquisition. Clear? Array, clear? If this is monkey, make sure this is also monkey. Please, that alone you take care. Clear? Then only I'll get it. Next, point number 2. See, for this I'm going to teach you something called a semi-infinity analysis through ledger, because whenever you find dividend bonus sums, no, pre and post will be confusing. To make it very easy, I'm teaching you one way which is very simple. Clear? Step number 2, calculation of goodwill or capital reserve as on the date of acquisition to be shown in consolidated balance sheet. Cost of investment in S Limited as on the date of acquisition 1st April for 60%. How much? 5 lakhs. This is okay, sir. Okay, this also you know. And you said investment should be subtracted because that rectification entry we passed. Step 2, step 4 you said. Okay, now we have to find what that and all will do, sir. That error rectification number will write. Now we have to find what net worth of subsidiary limited as on 1st April. As on what April? 1st April. In this pre and post also if you take, correct? When is the date of acquisition? 1st April 23. Date of acquisition also this. 31st March they are asking. So on the date of acquisition, pre is 0. Everything is what? Posted. So 0 is to 12. What is that? 0 is to 12. Listen to me. Listen. Equity share capital as at the end of the year is how much? 8 lakhs. Correct? This is including bonus, excluding bonus, including bonus. During the year, how much they have received? 3 lakh we have got. Correct? During the year, how much? 3 lakh. Up beginning of the year, it should be only 5 lakhs. Listen, even though we have to write 5 lakhs, post acquisition 3 lakhs, what I say is, don't write in post because we will not pass any entry. There is a huge logic which I would have taught you in the regular class. Clear? Listen, when you are taking whenever bonus is there, don't consider bonus here. Clear? Because for that we will not pass any entry. Indirectly we have to account the capital profit which should affect capital reserve. So instead of writing the 3 lakhs here, including bonus, you please write it in the equity share capital to get the answers right. There is huge logics if you remember. Clear? Listen, so even though at the closing of the year 8 lakhs, during the 3 lakhs, beginning 5 lakhs, okay, please consider, don't write 3 lakhs in the post. Please consider what bonus also in the pre-acquisition period. Clear? Many logics are there. Even EPS, you remember, whenever bonus is there, it is treated like a bonus element as if it is existing from the beginning. In that logic also you'll do 2-3 logics I can tell. First we will proceed. Okay, closing is 8 lakhs. Here also including bonus you take. Don't consider this. Mark it as important. Revise this 1 or 2 times before exams also. Clear? Next. Okay, sir, what is the reserves balance of subsidiary limited? We will see. Clear? Reserves balances of subsidiary closing is 5 and 9. Correct? Beginning what they have given is 3 and 4. But story is you cannot take just like that. Pre and post, 3 and 2 post, because here bonus and dividend adjustments are there. So simply I don't want you people to take just like that. For this I am going to teach you some ledger accounts. After teaching you ledger accounts, pre and post I will write it. Clear? Don't write because bonus adjustment is also there and dividend adjustment also there. For the purpose of pre and post, to find how much is pre, how much is post of reserves and P&L, unlike other questions, you cannot take just like that. Sir, closing they have given this much, opening this much, so everything is 0 to 12, everything will take it to post. Don't do such things because that sums we don't have any adjustments like bonus and dividend. In the sum we are having bonus and dividend adjustment. Please hold on, because bonus and dividend we have to pass entries where P&L reserves will be affected. That for that I am teaching you this. Clear? Point number 1. Okay, as per the question, opening balance as per the additional information is 5 lakh and 2 lakh. Closing balance as per the given balance sheet is what? 3 lakh and 5 lakh. Clear? Now let me do one by one. Okay, in this first 3 is okay, opening balances. 4th and 5th if you are done, we are done with this. Clear? Listen, first as per the sequence, whether dividend is paid first or bonus is first, dividend date is first. So timeline if you put date of acquisition, date of balance sheet. Correct? Just like that you cannot take opening balance this, closing this, everything is post to 12 months. So don't do, because what is their dividend bonus there, entries will affect the equity part. That's why. Clear? So dividend is taking place on 1st June, bonus is taking place on 1st October. First finish what? Dividend. Dividend is appropriation of profit. It is treated like withdrawal of profit. Clear? Point number 1. Who is declaring dividend? Yes, we are investing. that fellow should pay us, correct? We are holding, we have to receive dividend, correct? So on 1st June, S Limited is declaring and paying a dividend at what percentage? 20%, correct? Okay, my question is, listen to me. On 1st June, how many shares only we are having? 50,000. Bonus happened after that. Clear? Therefore, dividend should be calculated on 50,000 shares, 80,000 shares, 50,000 shares. Had a bonus occurred first, dividend next, then at the time of dividend, we will have what also? Bonus to totally 80,000. AS13. You remember, like that you have to do. In the sum, dividend happened first. That's why dividend is calculated on what shares? 50,000 shares into face value into dividend rate of 20%. Therefore, listen to me. I'll teach you very aram se. I'll teach kana. You will love this. Super it will be. Clear? Listen. I love this kana. I am teaching this consolidation for what number of time also I don't know. I'm teaching that many times. Every time I'm teaching, that excitement is having, even though it is revision also, I'm having that excitement. Listen, dividend. We have to calculate for 50,000 face value only. You have to take into 20%. How much? 1 lakh. So what entry? Listen, first I'll come to this part. What entry these people will pass for dividend declaration? P&L account debit to bank 1 lakh and 1 lakh. Correct? P&L account debit to bank account 1 lakh and 1 lakh. So P&L account is debited. Therefore, go to P&L account. Okay, go to P&L account, debit to bank. Okay, sometimes these people will affect reserves also. Instead of writing P&L to bank, they will write what? Reserves account debit to bank. Sometimes dividend utilization reserves will be there, but AS21 interlevel, don't think so much. Clear? So I will go with P&L. Reserves also you can take same answer only, you will get. Clear? So P&L account is debited. P&L account is what? Debited. Clear? So with this, dividend is completed. With this, what is completed? Dividend. Now S Limited is declaring entire dividend of 1 lakh. Entire 1 lakh we will receive, or only 60% we are holding, 60% we will receive 60%. So out of 1 lakh, holding company we will receive only 60. Outsiders will receive 40. So 60 is our dividend. 60 is our dividend. You remember that adjustment entry I told you, rectification. This fellow pre-acquisition dividend they have passed wrong. The rectification entry for pre-acquisition dividend is, what is the entry? I said the P&L account should be reversed, investment should be credited. Our share, we holding company committed mistake, their dividend is only how much? 60,000. Correct? So 60,000 and 60,000. So subtract the investments. Correct? Subtract the investments by 60,000. Therefore, your cost of investment is not 5 lakh. Your cost of investment after adjusting is what? 4,40,000. When you are consolidating, you have to follow other standards also, whatever you have to follow to the extent which we have to follow. 440. With this only you have to compare the net worth of subsidiary company. Clear agana? Sir, what about this P&L 60? When I am preparing consolidated financial reserves and surplus, when I am preparing what? Consolidated reserves and surplus, P&L, we have to subtract how much? 60,000, error rectified. Clear? Done. Sir, okay. Dividend we have completed successfully. Please teach that person also. Who is that person? Bonus. Okay, bonus. Recent amalgamation revision also I would have thought. What is the journal entry for bonuses? Okay, first bonus to shareholders account. I'll write so that you can also write somewhere. Bonus to shareholders account to equity share capital. Generally, when we issue shares, we have to receive amount. Then entry is what? Bank account debit, equity share capital. Here we are receiving cash. Bonus itself is free. Bonus itself is free. So you cannot write bank. So you'll write it as bonus to shareholders to equity share capital. Then you have to write it off using what? Reserve. CRR account, securities premium account debit, free reserves account debit to bonus to shareholders. If you cancel bonus to shareholders, what is the net entry? Will have reserves account debit to equity share capital. Therefore, bonus ko what is the journal entry? Reserves account debit to equity share capital. Clear? How many bonus shares subsidiary is giving? 30,000 bonus shares. Correct? So bonus shares. Okay, this entry you remember. Now only I thought you. Correct? How many bonus shares? 30,000 into face value. What is the bonus value? 3 lakhs. Correct? What is the journal entry subsidiary they would have passed? Reserves account debit. This only no. Reserves account debit to equity share capital 3 lakhs and 3 lakhs. Correct? So reserves account should be debited. Reserves account should be debited. So that's why in reserves account I would have written what? 3 lakhs I would have written. Clear? Everyone? Clear? Equity share capital increased 3 lakh. That's why 5 lakh plus 3 lakh in closing balance sheet 8 lakhs they are showing. Clear? So that is how you have to do. Sir, why we are doing it? Wait. Analysis of reserves and surplus of which company? Subsidiary. Because subsidiary is paying dividend, subsidiary is giving bonus, that we have to account it. Wait and see. Why we are doing it is to find the net worth of subsidiary limited. After considering all the adjustments of bonus, dividend, everything we have to adjust. Then we have to find the net worth. Clear? Hello? Now listen. After passing this entries and in exam slightly you do the ledger, okay va, full format. I'm telling you as a gift, I am telling you full format, okay, whatever I'm doing, step 1, step 2, are you able to see kana? Step 1, step 2, okay, step number 3, supplementary information, okay, this general is a P&L, this format, whatever I'm for, everything I'll give you, okay, have fun. This is my gift to you, okay, so that everything will be in one single place, you will enjoy it. Clear, ma'am? Okay, wait, let me go to the sum and let me finish it off. Listen to me. So what we are doing is we are preparing that ledger and we passed a entries. Now story is you have to close the ledger. Clear? See, opening balance is 5 lakhs, closing is 3, and this fellow is what? Okay, listen, this fellow is opening balance, closing balance. You see the debit side total 3 plus 3 6, but here you are having only 5 lakhs. There is a difference of how much? 1 lakh. It is nothing but reserves is increased by 1 lakh, which we would have transferred from pre-L. Automatically will come, we have to pass the entry, we have to pass the entry. What entry they would have passed for this 1 lakh is, what entry ra? P&L account debit to reserves and surplus, means reserves account, correct? That's why reserve is increased, correct? Reserve is increased. P&L is also debited. No, P&L should be debited. This place, majority of the students are getting confused. When you see, I say study material, they will not prepare ledger account. Straightly they will add minus, they will add and minus, okay? While adding, people will see, why in reserves they have showing, here also they are showing, here also they are showing, correct? Because of journal entry. Because of journal entry only, in one place they will show this 1 lakh, in P&L they will show subtraction 1 lakh. Clear? That is why pass. Remember this journal entry. Because of journal entry only, it will affect what? P&L account also. So P&L account should be debited by 1 lakh. Clear? So always remember in exams, whenever a dividend bonus is there, please prepare ledger account so that life will become very easy. From this, finding pre and post is very, very simple. Okay, those who are already those who have attended regular class, they also know what I'm going to tell next, correct? And those who are seeing for the first time, you will love it, kada. Just 2-3 times you just to see, practice, not seeing, practice once, then it is in your control. Clear? And similarly, this is also opening balance, this is closing balance. Now let's close. So this is balancing figure, this is what? Balancing figure 1 lakh, correct? Similarly, I will also open what? Like, P&L also, let me close. 1 plus 1 plus 5, total 7. From 7, if 2 is gone, what is the closing balance? That is balancing figure 5 lakhs, which is nothing but profit for the current year. Sir, why we are doing this? To find whether it is post period amount or pre-acquisition amount. Point number 1. See, are you all there, kana? What I'm going to do is, instead of analyzing 3 lakh and dividing the 3 lakh into, kana, instead of analyzing 3 lakh, how much is the pre, how much is the post, what I'm going to do is, instead of analyzing 3 and dividing pre and post, leaving that, I will analyze every other person, because 5 lakhs, 5 lakh should be 5 lakh only. No, 5 has become 3, means who is the contributors for this 3 lakh? 1, 2 and 3, correct? Because of these 3 fellows only 3 lakh is there. So instead of dividing this 3 into pre, post, who is pre, who is post, instead of doing that, they are telling, array, who is the contributor for 3 lakhs? These 3 people. Whether you analyze these 3 people separately or analyze this and divide into 3, same answer only you will get, correct? Therefore, what we are going to do is, leaving the closing balance, we will analyze the contributors of closing balance separately to find whether it is pre or post item. Clear? Point number 1. Balance brought down means what? Opening balance. Opening balance means for last year, closing balance means even before acquisition this was there. Therefore, this is pre item or post item? Pre item, correct? Clear? So this is pre. So I am writing this as what? Pre. Clear? So in pre I am writing 5 lakhs. Okay. This I am writing it as 5 lakh. Okay, bonus also, if you see in the question, they would have told it is issued out of reserves on the 1st April 2023. See, bonus we are giving, no? Correct? Bonus we are giving, right? Bonus 3 lakhs we are giving, na? They are telling bonus is out of what? Opening balance only. Apo, if this is pre, this will also be what? Pre. Clear? What about this 1 lakh? Whether this is from previous year, current year only happened. Current year, at the end of the year only, we will transfer. Correct? Therefore, this is after acquisition or before acquisition? After acquisition. Therefore, this is post. Correct? So, this fellow is pre, this fellow is pre, this fellow is post. Correct? Instead of analyzing 3, how did we get to 5 lakh plus 1 minus 3? That to pre post. Instead of analyzing that, they are telling, leave that fellow. Start from here and go to this person. This is why we will call it as what? This is semi-infinity. Infinity means like this. Correct? If I don't write that and if I am analyzing only that part, means we will call it as semi-infinity. So this analysis can be named as what? Semi-infinity analysis. Clear? So they are telling, array, this is pre, this is pre, this is post, correct? Therefore, pre, this is in the opposite side, correct? Let me write pre under reserves, pre comes, pre values are what? 5 lakh opening balance, bonus 3 lakh. But my question is, and what about this 1 lakh? This is post value. This is what value? Post value, correct? Hello, my question is 5 and 3, whether they are in the same side of the ledger, opposite sides, opposite side. Opposite side means what? Subtraction, correct? So 5 minus 3, pre net value is what? 2, correct? Post is 1. Therefore, if you go to pre and post in the supplementary, we know closing balance is how much? 3 lakh. In 3 lakh, what is the pre amount you said? Net value is 2 and this is 1, correct? So pre is 2 and this is 1. Put together 3 lakh. That's why I said don't take array 3 lakh. Opening itself 5 lakh. You will get confused. That's why I'm telling. Go with the ledger account. Go with the ledger account to make your lives very simple. Clear? Clear? So if you add, make sure you are getting what? Closing balance. If you do the valuation, okay, this net, this one should give you what balance? Closing balance. Should give you what balance? Closing balance. Clear? Similarly, we will do for what also? P&L also. P&L. Alright, this is pre because opening balance. Out of this only dividend will be given generally. See, if question is silent, dividends will be declared out of what? Opening values. Clear? Clear? Last year dividend will be paid in the current year. That's why it is called as pre. Out of opening P&L only they will do, because at the end of the year they have to find, it will take time. So opening only they will do. If this is pre, this is also pre. If this is post, current year means this fellow is also post, correct? So pre, current year means post, current year amount only you are transferring, correct? Then only it is post. Clear? Everyone able to understand? Always remember, if they specifically say reserve of 1 lakh, what is that? Reserve of 1 lakh. Okay, reserve of 1 lakh is transferred out of opening balance only. If they say this reserve of 1 lakh is transferred from opening balance, then only you should consider as pre. If question is silent, out of current year only we are transferring. If this is post, this is also post. Clear? So you tell me, leaving the closing balance, you analyze everyone, correct? Semi-infinity analysis, you will get what? Pre, this dividend will be pre. Post, this fellow will also be post, unless they specifically say reserves are created out of opening balances, then only will be pre. Clear? So listen, so for P&L also, what are the values? Pre, 2 and 1 opposite side. So 2 and 1 opposite side subtract, so net is 1. Similarly, post, correct? Post and post, same side, opposite sides are opposite side, means what we have to do? Subtract. So opposite side 4 lakh. So leaving, instead of sticking and analyzing the 5 lakh, how did we get the 5 lakh which is post and pre? Instead of analyzing the closing balance, if you analyze all other components, we will call it as what? We will call it as semi-infinity analysis. Semi-infinity analysis means leaving the closing balance, you are analyzing other components who are contributing for that closing balance. They are called as semi-infinity analysis. Clear? That 3 lakhs, that is net 1 and 4. Total comes to how much? 5, which is the closing balance as per the question. Clear? So closing balance is 5. Okay, see, closing balance is 5. What is the net pre? 1. Post net is 4. If you do like this, your answers will be easy. Instead of analyzing P&L opening itself 2 lakhs, or how to calculate, don't get confused. Do in the same way. One time I'll revise. Pre, this one will be pre. Post, pre, and this fellow will be post. Closing balance you should not analyze. If you analyze everything, no, answer will be 0. Clear? So please be conscious in that. Clear? So pre values you are adding up, post values you are adding up. One more point you are remembering, don't take bonus here because there is no journal entry. Clear? Include in the equity share capital, because that is a profit, like merge it for finding goodwill or capital reserve indirectly. Clear? 11 lakhs, 5 lakhs, holding company, minority interest. So step 2, 3, step 4, 3. Accordingly, you get what are values of pre and post. So accordingly, you get it. Clear? So step number 2, 660. How much we are paying? For 660, we are paying 440 only. So there is a capital reserve of 2,20,000. Clear? You remember regular class, I would have thought one more point there in the capital reserve logic. Now since we are in revision, let me go quickly. Listen, so you are getting as per the calculation, minority interest, reserves also opening balances, post acquisition share, and you are getting this. How did we get the 60 and 240, sir? Listen to me. How did we get the 60 and 240 is, okay, reserves, post acquisition 1 lakh, but our share is only 60%, 60, 4 lakh. In that our share is 60%, 240. So take that alone, add it, and error rectified. On the date of acquisition, capital reserve, get the values and do the consolidation accordingly. You will get the values. Clear or not clear? This is consolidated balance sheet for you, sir. Till now we are talking only about equity shares, sir. What if subsidiary company is also having preference shares? In that we are also holding some portions, sir. Correct? Then they are telling to the extent of whatever shares you are holding. For example, they are having preference share capital of 10 lakhs. In that 30% you are holding. In that control is not required. Any percent, 30% you are holding means to that 30% you would have invested. No, say for example, you would have invested 4 lakhs. Okay, so 4 lakhs is the cost of investment. 10 lakh into 30% is how much? 3 lakh, 4 lakhs. So you have invested more. So you have to consider for goodwill or capital reserve. You have to consider for what? Goodwill or capital reserve. In this case, goodwill. So for equity shares, how are you finding goodwill or capital reserve? Same like that you have to find for what? Preference shares also. Same like equity. For preference also, to the extent whatever we are holding, find goodwill. For equity separately you find. For preference you find goodwill or capital reserve separately. Then lastly you consolidate. Sir, equity also goodwill, preference also goodwill. Add both the goodwill, show in the consolidated balance sheet. Sir, here also capital reserve, for preference also capital reserve. Add and show it in the consolidated balance sheet. Clear? Sir, here goodwill 1 lakh, sir. In preference we are having capital reserve 20. Net to whoever is higher you have to show. If net to goodwill is higher, goodwill. If net to capital reserve means net to capital reserve. Clear? Same is the case for debenture also. If that fellow is having, come on, if subsidiary company is having what? Equity share capital, preference share capital, debentures, same. In that assume 30% we are holding, sir. Okay, debentures we are holding 20%, 100 lakhs. Clear? They are telling. You found step number 2, what for equity share capital you found something, cost of investment minus holding company share of net worth, like that you have to do for preference share capital as well as what? Debentures. Cost of investment minus your share of holding. Clear? Similarly, cost of investment minus your share of holding in the face value or debenture value in that. Clear? Get goodwill or capital reserve, consolidate everything. Whoever is higher, that net we have to show in the consolidated balance sheet. Sir, then 70% will be held by some other person, 80% will be held by some other person. This you have to add it in what? Minority interest. Correct? In step number 3, along with equity share capital, add this people also. You will get the answers. Clear? One sum I will teach you. Similarly, after the, see, if you are having cumulative preference shares of subsidiary company, after giving effect of cumulative dividend, whether paid or not, after giving the dividend effect, after adjusting the P&L reserves, everything, whatever is the amount, that time you have to do the line by line consolidation. After considering all the dividend, whether paid or not paid, after adjusting that, then only you should do for what? Line by line consolidation. Clear? If it is not cumulative, no need to adjust it. Clear? So what is the story is preference shares held by the holding company. Preference shares held by the holding company. Okay, it should be treated in the same way as equity shares. Goodwill or capital reserve is computed. Consolidated balance sheet you have to prepare. Portion of preference shares held by the minority interest should be added in the minority interest. In this sum, if you see, okay, in this sum also, preference shares, if you are able to see, subsidiary is having 1000 preference shares. In that, H Limited is purchasing 75% interest at the beginning of the year at a premium of 25%. Sir, but investment they have given something. No, sir, that investment, this investment not same. Not same. Clear? Something, some other number we are going to do. Clear? The P&L, see, one more point I will tell you. The P&L of S Limited, that is the P&L of S Limited includes 10 lakhs. Everything is in what? Lakhs, thousands. Okay, va? In this, everything is in thousands. Actually, everything is in what? Thousands. In this, 10 lakh means what? Thousands. Clear? In this 1790, 1000 is brought forward from previous year. That is, indirectly they are telling opening balance is 1000, closing balance is 1790. After dividend adjustment means they have adjusted the dividends. In P&L account we used to prepare what? Dividend adjustment to bank I would have written. No. After adjusting dividend only the balance was how much? 1000. Clear? means when you are preparing P&L account, when you are preparing what account? P&L. Why sir P&L account you want to prepare? I said no, dividend, bonus or both are there. You have to prepare P&L and reserve to make sure you are getting the answers very quickly. Clear? So 1000. What is that, ma? 1000 we are having. Correct? So 1000 bank balance. Okay, that is P&L account. This 1000 is after what? Bank adjustment of dividend adjustment. So once again in P&L don't write dividend because this 1000 is after adjusting the dividend. Once again you should not write. That's why dividend payable account is visible here. What is visible here? Dividend payable account is there in the balance sheet because they have adjusted the dividend. They have already taken to P&L. After taking to P&L only, opening balance is 1000. Closing balance comes to 1790. Clear? Both the directors of both the companies have declared the dividend at 10% on equity shares for the previous year. You are required to calculate goodwill or capital as a minority pre and post acquisition profits. Clear? See, since dates are not given, I will take it as what? Beginning of the year, end of the, I think ICSM also it is there, the same I think. Okay, degree of control, H limited, minority interest. How much we are holding is, we are purchasing what? 75% of equity shares at a premium of 75%. Clear? Clear? So holding company we are having 75%, 25%. Sir, they did not talk. See, when they say 75% of the interest, generally they are talking about equity. But they did not talk about anything about preference now, sure. Preference, they did not talk how much we are holding. If they did not say anything about preference shares, how much we are holding, it means nothing we are holding. Entire preference were held by outsider. So entire 1000 is what? Minority interest only. So in step number 3, when you are calculating, whatever you do for equity, lastly add this 1000 relating to preference, which I will show you also. Clear? So preference shares, holding company, we are not holding anything. Minority interest 100%. Minority interest how much? 100%. Step number 2, calculation of goodwill or capital. So cost of investment on the date of acquisition. Point number 1, how much is the equity share capital of subsidiary? 5000. In that, how much percentage we are purchasing? 75%. That too at a premium of 25%. So 5000 into 75% we are getting 3750. We are not getting at 3750 itself. We are paying 25% extra. Therefore, how much is the cost of investment? 4687.50. How much? 4687.50 we are getting. Clear? Next, these people are declaring dividend. How much percentage dividend? 10% dividend. Correct? So I will do analysis. Okay, analysis. General reserve and P&L, dividend is there. General reserve opening is 800, closing is also 800. How, sir? Because if you see what is the general reserve value, closing balance is 800. They are telling in the question the general reserve is also brought forward from what? Previous year. Means closing 800 means that 800 is from the beginning of the previous year. Means which is brought forward from the previous year. From the beginning of the current year itself, it is 800 only. So if closing is 800, they are telling this is brought forward from the previous year. Means opening is also 800. There is no change. Clear? There is no change. Entire amount is what? Pre. So I am writing it to pre. Correct? When it comes to P&L, okay, opening they said how much? 1000, already adjusted with the dividend. So dividend I am writing it as nil. Closing how much they said? 1790. Therefore current year how much I would have taken? 1790. Clear? This will be the balancing figure. So whatever balance sheet they have given, that is closing balance sheet. Okay. So in the sum they told no adjustment number B, I think so. Second adjustment, 1000 is after adjusting the dividend, which is opening balance. Clear? Clear? Therefore this fellow is pre. This fellow is post. Dividend nothing we are having. Clear? So 1790. If you see, this one will be pre, this one will be post. Clear? So as per the steps, what we will do? Step 4, that is 2343. Correct? 2343. So 5100. 5100. Point number 2. Listen. 5100. Okay, I will take 5100. Now these people are declaring dividend. How much percentage dividend they are declaring? They declared 10% dividend. How much they are having? 5000. The dividend is adjusted, but we have to find out how much dividend, how much we have to account. So 10% on equity share capital. Subsidiary limited is having 5000 shares. 5000 thousands actually. 5000 because everything is what? Thousands. Correct? 5000 into 10%. What is that? 5000 into 10%. Entire 500 will receive, or in that 75% only we are holding equity, 75% only. So we will receive only how much? 378. Sir, why are you subtracting dividends, sir? That is called as pre-acquisition dividend. It is assumed that we have acquired in the current year only. Correct? We are acquiring in the current year. In the beginning of the current year only we are acquiring. So they are telling means last year, relating to previous year you are receiving. That is called as what? Pre-acquisition dividend. Pre-acquisition dividend, what is the correct journal entry? Journal entry is bank account debit to investment account. Sir, but the last time you passed a P&L to investment, there they have committed error. Instead of crediting investment, they have credited P&L. So their error happened. Rectification entry is P&L account debit to investment account. Correct? Here error and all, nothing happened. They did not pass the entry which we are going to pass. So investment should be reversed. Correct? So subtract the investment. Don't affect consolidated P&L because they did not commit any mistakes. Correct? So this alone we have to pass. Bank account debit to investment account. This alone I am just writing as 375. No error in this sum. Clear? No error. That's why I did not pass the entry. With that, what is the net cost of investment? 4,312.50. With that, holding company share 5,100. Therefore, capital reserve we are paying less, 787.70. This is capital reserve. And minority interest, what we'll do? 1,700 plus 197.5. Correct? 197.5 added. Here, as I said, same like equity, preference shares, nothing we are holding. So that's why I did not calculate for goodwill or capital reserve for preference. This is for equity. In preference, I did not calculate anything because we are not holding anything. Clear? So entire 1,000 we will add it with the minority interest because everything held by the minority. So total will be 2897.50. Here also holding companies post acquisition share of profit, whatever number you are having, capital reserve you are having. Clear? Don't adjust that error and all. Don't do such things. Clear? Because it is not at all error. Debenture also, as I said, same story you have to do. Clear? And sir, unrealized profit on sale of non-current asset. For example, holding company will be there. Holding company will sell one asset. For example, PP will be there. PP, they will sell it for what? Subsidiary company. They will sell it for what company? Subsidiary company. Clear? They will sell it for what? At a profit. Internal profit allowed or not allowed? Not allowed. At least for inventory, it will be sold to outsiders, it will be realized. Non-current assets and all, we will not realize. Correct? So, internal profits, if it is allowed by AS21, no, people purposefully they'll sell it at a profit. For example, holding selling to subsidiary, no, what happened? Holding profit I would have increased. Correct? Allowed or not allowed? Not allowed. So decrease holding company's profit. Decrease what? Holding company's profit. There what they would have done? Their asset value they would have increased. Decrease that asset. Clear? Clear? I will do with one sum. H Limited acquired, okay, 70% of H Limited few years back. H Limited transferred plant and machinery to H Limited for 60,000 in the beginning of 2025. H Limited got it for how much? 1 lakh in the beginning of 2022. Useful life is 5 years. On the date of transfer, useful life remains unchanged. Okay. Accountant says whenever you people are transferring like this, we will account as if there is no profit, there is no increase in the asset value, there is no increase in depreciation. What are you saying, sir? I will tell you now. Listen. If one group entity sells non-current asset to some other company, adjustment must be made as if the sale had not occurred. That is, there is no profit and the depreciation will be carried at original cost itself, not on the revised value. Okay, now I will teach you. When did we get purchase the asset? 2022, 1 lakh value. Correct? In 2022, we purchased the asset for how much? 1 lakh. How many years? When are you transferring? 2025 beginning. How many years passed? 3 years passed. What is useful life? 5 years. So, had the transfer not taken place, 1 lakh, 3 years depreciation, I would have subtracted 60. In my balance sheet, I would have shown at what value itself? 40,000 itself. So in my balance sheet, I will show my PP at what itself? 40,000 itself. And the third year also, that full year, the current year also, I would have charged depreciation 20,000. And fourth year end in my balance sheet, I would have shown asset value at 20,000 only. But instead of this, what I did is after 3 years, I transferred to my subsidiary company. Subsidiary company, I transferred it for how much? 40,000 worth of asset. I am selling it for 60,000. So what happened? Subsidiary will inflate the asset by how much? 20,000 more. Correct? And they will charge depreciation also on 60,000. How many years left? 2 years left. So each year they will charge 30 and balance sheet they will show as 30. Right or wrong? Wrong. If accountancy allows this, now people will transfer internally, they will overstate the asset, they will charge more depreciation, they will overstate the values of the asset. And this will also include what? Profit as 20,000 because 40 is selling for 60. This is unrealized, this is overstated, this is overcharged. charge depreciation, correct? So three things, P&L should be eliminated, assets should be reduced to 20, from 30 we have to bring it to 20, depreciation you charge more, that you have to reduce, correct? Therefore what entry we have to pass is, we have to check who is selling to who. If holding is selling to subsidiary, then what we have to do, holding company 20,000 should be reversed. So holding company profit is called as consolidated reserves. So in step number 4, consolidated reserves should be subtracted by 20,000, PPE 30,000 these people are showing. So subsidiary company's PPE should be reduced by 10,000. So PPE of subsidiary company 10,000 we are going to reduce. Similarly, like depreciation in P&L, how much they have charged? 30,000 they have charged. How much only they should have charged? 20 they should have charged, correct? So these people have debited P&L excess by 10,000, that should be reversed. So P&L should be reversed, credit 10,000. So that's why I have written subsidiaries P&L 10,000 reverse. So repeating, holding companies profit should be reversed to the extent of 10, PP of subsidiary should be reduced, and P&L excess depreciation charge, no, that we have to bring it. So it's P&L extra debited 10,000, that you reverse credit, okay? So instead of debiting 20, I have debited 30. So reduce the 30, means 20 only you have to reduce, no? So extra you have debited 10,000, that you have to reverse credit the P&L, which will call it as retained earnings. So when holding or parent transfers to subsidiary, we are reducing parent's profit, okay, subsidiaries asset and subsidiaries P&L we are increasing. Clear? Subsidiaries asset should be decreased, P&L should be increased because overcharge they would have done. Clear? Step 4, step 3. Clear? Accordingly, I have written here. Clear? So consolidated retain, sir. Okay, parent selling means parent's profit you are decreasing, subsidiaries asset decreasing, subsidiaries P&L increasing. What happens if subsidiary selling to parent? Then what happens? Subsidiaries profit should be decreased, parent PP should be decreased, parent's P&L account should be increased. That is what I have written here also. Clear? Sir, when I am consolidating, sir, what is happening is, when I am consolidating, my accounting policy is one, subsidiaries accounting policy is one. What we have to do, sir? Correct? Then accountancy says, when you are consolidating, make sure accounting policies are same. You make the changes to bring it to your accounting policy, then same accounting policies you have to do. Clear? After that, you should do line by line consolidation. Clear? So first make the adjustment to the relevant asset and liability, then make the line by line consolidation. Give the impact in what? Step number 2. Clear? Accordingly, you have to follow this. Clear? And sir, when I'm consolidating, holding company balance sheet, for example, whatever dates I have given, if I have given the balance sheet dates, okay, see 31st March of what holding and subsidiaries should be same balance sheet, separate financial statement should be same. It should not be a different accounting period. Sir, holding is following what 31st March, this fellow is following some other accounting period. Sir, what we have to do? Like that itself we can consolidate. You should not consolidate. You should ask your subsidiary to prepare additional financial statement which is matching with the holding. If it is impracticable to do, then they are telling, if it is impracticable to prepare one more financial statement because of restrictions in that particular country or whatever it is, they are telling you, okay, subsidiary are not able to prepare one more balance sheet which is matching with my financial year. No sir, I am not able to prepare. Clear? Then accounting standard says, okay, whatever is your most recent financial statement, I will take that. Any significant changes from that date to my consolidation date, I will make it, and I will start consolidation, but difference should not be greater than what? 6 months. Clear? And whatever is the difference, okay sir, this time I am taking December, here is 31st March, sir, 3 months date I am adjusting, I'm consolidating. So if this year 3 months means next subsequent year also the difference should be only 3 months. Every time you should have first year 3 months, next year to 4 months, that and all you should not do. Clear? Follow consistently. Clear? Hello? And one sum is there in what relating to this accounting for policies changes in ICA study material, this particular question, subsidiary of B Limited. Okay, quickly I'll tell you. B Limited is subsidiary of A Limited. Okay, B Limited is what? Subsidiary of A Limited. Everything of what limited data they have given? B Limited data they have given. What limited data they have given? B Limited data they have given. Okay, so B Limited is subsidiary. Both the companies follow calendar year. Leave it. A Limited, clear agana? We are A Limited holding. B Limited is subsidiary. A Limited we are following weighted average method, but subsidiary is following FIFO method. To bring B Limited's value in line with the holding company, its value of inventory is required to be reduced by 12,000 at the end of the last year, and in the current year and 34,000 they are telling. Actually our current year is 2021. Whoever have seen the sum and IC study material, I'll give clarity in that. Clear? They are telling, okay, because of changes, what happened last year value, how much I have to reduce? 12,000 I have to reduce. Current year value, how much I have to reduce? 34,000. Accountant says last year closing balance would have become opening balance, so that and this will have been nullified. Clear? Current year only you have to consider for current year consolidated balance sheet. So 34,000 you have to reduce. Okay. Similarly, B Limited deducts 1% as trade receivables as general provision against doubtful debts. These people subsidiary, whatever happens, see, holding, we will create provision for bad and doubtful debts only when there is a doubt. Correct? But these people will actually what they will do, they will deduct what? TD, they will deduct 1% as provision for bad and doubtful debts, whether there is a anticipated loss or not, they will deduct. But accountancy says, are a holding company, will you do like that generally? No sir. Then why are you allowing him? Reverse it. What entry he would have passed? Bad debts account debit to PDD account. Correct? Bad debts account debit to PDD, that is P&L he has debited. Reverse the P&L. Reverse the P&L account. Clear? That also we are going to do. So first let me show you this. Okay. What they're asking is restate the balance sheet after considering the above for the purpose of consolidation. Would the restatement would make the accounting policy adopted by the A Limited and B Limited uniform? This is okay. Okay. That points. Clear? Whatever I thought you. Consolidated balance sheet, only reserves we are going to restate. Listen to me. So reserves as per the question given is how much? 7,14,000. So go to reserves. Go to reserves. Current year reserve is 7,14,000. So take that as a starting point. Clear? Point number 1. Listen how cleverly you have to understand. I will tell you. Sir, okay, first you are telling about inventory last year closing and this year opening nullified. So current year alone we will subtract. So only 34,000 we are going to reduce from the stock of what company? B Limited. Clear? That I am reducing. Clear? Next, provision for bad and doubtful debts. Sir, 7 lakh, they are showing us one value, sir. What is that value? 9,000. How did they get the 9,000 value? They are telling 1% already provided. After subtracting 1%, your trade receivable is 8,90,000. That is, in the beginning of the year, 900% you have subtracted what percentage? 1%. Correct? Whatever you are showing in the, whatever you are showing, correct? We are showing only what percentage? 99%. I need what percentage? 100%. Correct? So if you reverse, that will be becoming how much? 9 lakhs. Therefore, this year how much you would have subtracted? 9,000 you have subtracted. So subsidiary has subtracted 9,000 as bad debts. So that what entry they would have passed? B Limited P&L account. That is bad debts means it will be closed and taken to P&L. No, P&L account debit to PDD account. So P&L you have debited. Now I want you to reverse it. Increase the P&L. That's why it is added here. That's why it is what? Added here. Clear, ama? So add 9,000. Okay, 714 plus 9, 723. Subtract this 34,000 and D point I will tell you. Advertisement, prepaid expenses in B Limited. Prepaid expenses in B Limited. Okay, include advertisement expenditure carried forward of 60,000 and 30,000 from the past years. Total how much? 90. Being a part of initial expenditure of what? 90,000 in 2000, which is written off over a period of 3 years. Upon each period, how much we have to write off? 30,000 we have to write off. How much we have to write off? 30,000 P&L we have to write off. So total how much we have to subtract? 34 plus 30. Correct? Reduction in inventory 1, because of that P&L will decrease. And one more is advertisement writing off. Okay, amortization 34 and 30. Total is 64. We are writing it off. Therefore, revised P&L value is what? 6,59,000. No adjustment is required for opening inventory because it will be nullified. Clear? Clear? So 659. It will be what? 659. This 659 only we have to take. And similarly, prepaid expenses. What expenses? If you see the working note, okay, prepaid expenses, you are having actual value of how much? 48. What is the closing balance? 48. So from 48 subtract this 30 also. You have to show how much? 18 you have to show. How much you have to show? 18. This 18 only they are showing here. Clear? Same with the case of what? Inventory also. All adjust. If you go to the working notes, actual inventory minus change in inventory valuation 7 lakh 8, that's 7 lakh 8. Depreciation is also fine. Provision for taxation, trade receivables and all, if you see, you are showing how much? 100% you are showing. You are not showing that 1% PDD, because policy of holding company is to not to create PDD generally. Whenever there is anticipated losses there, then only we will create. Clear? Sir, they did not say now how we will assume. We will assume. We have to assume like that only. Clear, ma? Hello? Like that we have to assume. Clear? So with that sum is also done. Clear, Akana? So this is with what? Consolidated balance sheet. This is with what balance sheet? Consolidated balance sheet. Everything else you'll understand. Sir, what about consolidated cash flow statement? Consolidated cash flow statement also they are telling whatever happens intercompany and all, whatever you are advancing, whatever he is giving, dividends received, that alone you eliminate. Other than that, whatever is with the outsiders, that you do line by line, operating line by line, investing line by line, and financing line by line you do. Same what you do in AS3 only you should do. Line by line you have to consolidate. Intercompany, that is intra-group transaction, you eliminate. If it is given loan, given financing activity will be there, loan given in one company and it will be received from some other company, that you eliminate. Just show the net impact alone. Clear? And more important point in minority interest, I'll tell you, this sum you can do. This is like, this sum is there, ISM sum, where they'll ask only step 3. Okay, step 2 and step 4 only they'll ask. Clear? This sum you can do. One important point in ISM sum is there. Minority interest, if you remember step number 3, what we used to do, minority interest share of net worth of subsidiary limited as on the date of acquisition plus post acquisition profit will add and will show 230 in the balance sheet liability side. Always profit will be there, loss will also be there, loss will also be there. Sometimes assume there is a loss of 1 lakh. Okay, in that minority interest is 30. So what we used to do, subtract 30. Correct? So I will show how much? 1,70,000, 170 I will show. Clear? But assume the loss is in such a way that the minority interest share of loss itself is coming to 2 lakhs. Already they are having how much? 2 lakh. Now their share of loss is 2 lakh. Therefore, how much the minority interest we have to show in the balance sheet liability side? Nil. Correct? Sir, okay. Profit is there, add. Lesser loss is there, subtract and show the net. Full it is loss, sir, then show nil. But sometimes it may exceed also. For example, opening balance on the date of acquisition 2 lakh. Okay, minority interest share of post acquisition is 270. Can you show negative? You cannot show negative. Accountancy says they will hit you with stones. They have given the amount, you have incurred the loss. So even though it is loss, you cannot subtract 270. Subtract to the extent amount available. Extra 70, what you do? That extra 70 in consolidated reserves and surplus. Okay, holding company's balance will be there. They will also have, assume there is a loss of what? Assume there is a loss of 9 lakh. Out of 9 lakh, 270 is for minority, 630 is for what? Majority. Clear? So 630 you subtract, but they are having only 2 lakh. You cannot subtract 270. Subtract 2 lakh. There 70 extra. Who should bear? The majority interest should bear that extra 70,000 loss. The majority, they have to bear what? Extra 70,000 loss. Therefore, how much is the consolidated reserves surplus? Means assume they are having opening. Holding is having reserves and surplus of 20. They are bearing 630 and extra loss of minority interest also. Who is bearing? Consolidated holding company they are bearing. And how much we have to show is that 3 lakhs we have to show. Assume in the next year also. In the next year also, subsidiary is having a loss. Okay, how much is the loss? 1 lakh. Holding company 70%, minority 30%. Correct? So minority loss is how much? 30,000. Already last year itself minority as I made it as what? Nil. This year once again loss. Can I subtract 30? This 30 also who should bear it? This 30 also holding should bear. Correct? Sir, already last year holding has borne how much? 70. Now they are bearing 30. Total loss of minority interest borne by holding is how much? 1 lakh. Sir, what to do, sir? Accountancy says, wait, when you get profit, don't give 1 rupee also to minority interest till you recover 1 lakh. Clear? That is what accountancy says. So next year we will see the situation. Next year there is a profit of how much? 90. Let's divide between holding and subsidiary. Assume holding is share is 70%, 30. Holding share is 63. So add it with the reserves. 27,000 you will give it to minority, or their share of 1 lakh we are bearing. They are telling till you recover 1 lakh, don't give 1 rupee also to minority. Keep the minority as what? 0. Don't add 27 and bring 27. Correct. That 27 also should be enjoyed by Hura, should be enjoyed by majority interest, that is holding company. So entire 90,000 we have to enjoy. But out of 1 lakh, it is treated minority has repaid how much? 27 they have repaid. Still how much they have to see? We will see. Okay, 1 lakh 50 next year. Okay. In that holding company 1 lakh 5, minority 45. Clear? Whether we'll give to minority, will not give. This 45 also we will take it. Clear? Till you recover entire 1 lakh. So 27 and 45 only we got, no, still more to go. Means 72 only we collected, still much amount is there. Next year assume subsidiary is earning a profit of 3 lakhs. So holding and subsidiary 90,000. Now question is, entire 90,000 will be given, or balance the 28,000 out of 1 lakh is still pending. 28,000 is still pending. So in this 90, collect 28, give the balance to them 62,000. So 210 plus 28, holding should have how much? 2,38,000. Clear? Therefore, whenever minority interest is having huge loss, you cannot show them in negative. When you can show in negative is if there is an obligation from the minority interest side that they have to make good the loss. If there is any obligation, that time only you can show in negative. Otherwise, you are not required to show it in the negative. When you write the answer, make sure whatever I have written in the highlighted in the blue you have to write. See, in such cases, I'll read this for you. The losses applicable to minority interest and consolidated, sometimes it may exceed the profits whatever they are having. In such cases, AS21 prescribes that excess or any further losses of subsequent year are to be adjusted against the majority interest holding company, except you see they are telling whatever is the excess loss you adjust with the majority interest. But when you can show it a negative means, except to the extent the minority is having what binding obligation to make good the losses. Otherwise you should not show. Who should take it? Majority interest should take it. Clear? This is what you have to do. Clear? Everyone? Clear that particular question. This question is also there, which is called a step acquisition. Which is called as what? Step acquisition. Straightly I'll get into the points. Okay. Variety limited, already we are having 46%, which is not controlled. More than 50% we should have. So we are having 46%. Ask them 10 minutes. So 1 minute. So small thing, okay. I'll explain you this question. Listen, variety limited holds 46%, means they did not have control till that time. Okay, now shares were acquired at a price of what? 17 per share. The balance 50, see 100% 46 only we are holding. 54% who is having is held by foreign collaborating company. The memorandum of understanding is entered between them. Okay, they are going to sell it. Clear? The shares held by foreign company will be sold to variety limited. They are going to sell us. The price per share is calculated by okay, these are the things I am going to explain. The price per share, when they have to sell, they have to fix a price. No, they are fixing the price. Calculated by capitalizing the yield at 15%. Yield for this purpose would mean 40% of the average net profits. The actual cost of the shares to the foreign company, when they purchase, for them the cost of purchase was 5,40,000. When they want to fix a price, they are fixing at what? 40% yield and 15%. I'll teach what is that. Okay, you cannot understand that. And one more point also, the profit that would accrue to them, actually pause it, read the full question, then you'll understand. Okay, the profit that would accrue to them would be taxable at an average rate of 30%, means a tax deducted at source. Whatever is the capital gain, in the 30% we are going to get it. Okay, out of whatever amount we are getting, 50% is given by them in cash immediately. 40% will be, that is balance 50% will be treated as what? Unsecured loan. This is the question. First, how much they are going to ask, sir? Question is, to get this 54%, they have to fix one PC. Now, how much PC they are going to fix? That particular information is there. Correct? This is for PC. What is that amount they are expecting? What is the investment value we are going to give? They are asking, whatever is the last 3 years average in that 40%. So they themselves, they are going last 30 lakhs, 40 lakhs and 65 lakhs. So 30 lakhs, 40 lakhs, 65 lakhs. In that average, how much? 45 lakhs. In that 40% means how much? 18 lakhs. In that how much? 18 lakhs. So yield of VR limited means whatever is the profit, or average profit, in that 40% is the yield. So price per share of VR limited. Okay, price per share of VR limited. See, VR limited is a company where we are holding shares. We are also holding, some other outsiders are holding the foreign collaborating company. So yield of what company? VR limited is 18 lakhs. Okay, now they are finding overall yield, means 18 lakhs. What is the yield percentage? 15%. So what is the overall value of that capitalization values? 120. They are telling, I want to know Actually, how many shares are there in that company, you know? In the last lines, if you read, the total assets of ER Limited is 100 lakhs. Okay, the company has written on PPE by 150, 175. Current liabilities also they have done to 20. Paid up share capital of ER Limited is what, 2 lakh equity shares. Simple, I'll tell you what to do is, actually in this 2 lakh we are already holding some portion. We have to get how much percentage? 54 percentage now, correct? For that 54 percentage only these people are entering into agreement. So 2 lakh shares into 54 percentage, correct, means number of shares will get, correct, 2 lakh means how much? 1,08,000 shares yet to be received. We have to purchase from that foreign collaborator to get 100% control. For this we need to fix a price per share now. For this price per share only this overaction they are doing. Clear? So sir, this is done. We are finding at what price they are fixing. To tell the price they are giving this much. Yes, okay, so they are telling our capitalization is 80 lakh. Overall capitalization of that is how much? 15%. So 18 lakhs is for 15%, means you are getting my 100% control. No, means 100%. What is my overall capital? Overall net assets. They are telling, for 15%, 18 lakhs, means for 100%, how much is your total value? They are asking. Okay, clear? How much is the total value of the business? 120, correct? So total capitalization value 120 divided by how many shares? 2 lakh shares. Therefore, what is that? 60 per share. This is one way of finding intrinsic value. One way. This, but we will not call it as intrinsic capitalization value per share. Clear? So at what value they are going to ask? 1,08,000 into 60 per share. So 1,08,000 shares into 60. Total how much they are expecting the PC? 64,80,000. Correct? 64,80,000. But we have to pay now. When we pay, we have to subtract the TDS. TDS tax, not TDS. Literally TDS means not TDS. Tax on the capital gain. Okay. So this is the sale value. Their cost is what? 5.4. Correct? In that, what is the 30%? Correct? So this value minus cost is a profit. In the profit, what is the tax amount? 30%. So the tax amount we are deducting, not TDS. Clear? So capital gain tax, assume like that. Tax at source like that. So 59.4 into tax amount we are subtracting. And now how much we have to give it to them? 46.98. Read the question clearly. That we have to deduct is what will be there in the sum. Clear? If you see in the question, okay. Tax payable deducted from the proceeds and variety will pay. We are called as variety. We are limited as a company in which we are investing. So that particular tax amount we are deducting, and how much we have to settle them? 46.98. In that 50% will be given in cash immediately. 50% will be called as unsecured loan. Clear? Agada? Clear? So this is what they are doing, and they are asking what? Calculate goodwill or capital reserve. Liability approach, asset approach. In the sum, asset approach only you can do. Clear? Correct? So 100 lakhs is asset value, and these are reduced as per the question, current liability and PP. Therefore, what is the net asset? 78.25. In that, correct? In that 78.25. This is a net assets. Already, how to find goodwill or capital reserve? Step acquisition, no, cost of investment and net assets. As on the date of final acquisition. What is the net assets you said? 78.25. This is for what percentage? For entire business. For entire business means what? 100%. Then if the net assets is for 100% means, then cost of investment should also be for what percent? 100%. 100%, how did you get? Already you are holding some portion. Now we are getting 54%. Correct? For 54%, what is the PC you are paying? Correct? 64.8. Correct? Already you are having one set of shares. Now for that, how much you paid? It is given in the starting of the question. For 46%, we are having how much? 17 per share. We are having what? 17 per share, which is 15.64, which is what? 15.64. So for this new 156 and for 44, 46, correct? Correct? So for that 46 and for this 54, totally how much is the cost of investment? 80.44. 80.44. For this, you are paying this much. Therefore, there is a goodwill of how much? 2.19. Clear? 46% means how many shares you find into that price you do. You will get the value. Clear? Everybody? Like that, if you do, you'll get the answer for this. And lastly, we are having what? Step acquisition is also done. To make you guys to understand little, I will have some notes like this. Please take the screenshot of this. Pause it and take the screenshot. This and along with this sum, if you read now, you will understand many things. Clear? Slowly when you get, this is called, what we did is step acquisition. What we did is called as step acquisition. Clear? In the illustration sum, whatever is the net assets they have given, that is for 100%. In the sum, whatever I have written, I would have given net worth on first acquisition and the subsequent acquisition. Sir, I did not get control in one or in a second or third, sir. If second or third means I can calculate separately goodwill separately for each of the acquisition. I got small portion like 1%. I got sometime I got 5% and 10%, then 2%, 3%. Like this, I have purchased so many times. Then I got control, sir. So many times I have to calculate goodwill or capital. You will die. Clear? Accountancy says, the date on which you got the last share, on that date you got. For example, you are having water, you purchase some 20 times, you are having 48%. Now you are purchasing for 21st, 3 more percent. Now you got control. Now they are telling this 21st day is called as date of acquisition, calculate goodwill or capital on that particular date itself. So, however, if small investments are made over a period of time and control is got on that last installment, for practical purpose, we are calculating that particular date is considered as date of acquisition. On that date we have to calculate goodwill or capital one time. No need to find for everything. Clear? So this also I'll keep it. Take screenshot. It will be very easy also. Okay. Take screenshot for your understanding. Okay. Many times I would have bought 40%. I got it many times. Next 15% I got it for 18 lakhs. Okay. So total 50% I would have got control. So cost of investment for 55 is 30 and 18, totally 48%. Correct? So on the last installment on the 15%, that day net worth, overall net worth is 75, in that 55%. So goodwill. Clear? Like this you do. Lastly, consolidated P&L. When it comes to consolidated P&L, okay, when it comes to consolidated P&L, same, line by line you have to add. Okay, line by line you have to add revenue from operations, other income you have to add, and mutually whatever. For example, sometime I will provide services to them, I will raise the invoice. Okay, holding company will raise the invoice, they will pay, we will receive. When I consolidate, I will consolidate line by line. No, kana. When I consolidate line by line, what happens is they are telling, array, within yourself you are paying, within yourself there is an income that mutually you have to eliminate. That is what they are telling. Clear? So mutually income and expense, I would have raised the bill, I would have received amount from my subsidiary. In his books it will be payment, in my books it will be income. So accountant says, add income, subtract this income, add those expense, subtract that expense. So whatever you have paid and received between you, it should be subtracted from the respective head. For him it is expense, from the expense subtracted. For you it will be there in the income, subtract in the income. So income also subtracted, expense also subtracted. Like that, mutually whatever is there you have to subtract. Any unrealized profit, it should be subtracted. Any dividends, whatever is already realized, that should be eliminated. Clear? So one sum, same like that. No changes, line by line we have to do. Okay, within the group any transactions are there, should be eliminated. Unrealized profit, eliminated. Clear? After that you have to do. There is one sum in ICA study material. Okay, and whatever is a profit lastly you are getting, that should be divided between holding and minority interest. Clear? So this is what I would have written. Okay, after determining the profit, it should be allocated between the amounts attributable to parents as well as what? Minority interest. So in this sum also, ICA study material, there are one illustration and one practical. I'll discuss the main point. Okay, see, they have given everything. Okay, changes in inventory also they have given. Clear? Listen, first, on 1st September, okay, Chand acquired 5,000 shares of 100 each, fully paid up. Okay, and Sitara has paid. Sitara is the company. We are acquiring means they are what? Subsidiary. Sitara Limited paid a dividend of 10% at the end of the year. A dividend was accounted correctly in the Chand account. Means they have to account it now. Clear? So, how many shares we are having is, listen, how many shares we are having is 5,000 shares we are getting in the adjustment, 5,000 shares of 100 each, not 10. Okay, 100 each, 5 lakh into 10% dividend we are getting. Correct? So how much is the income we are realizing? 50,000. Can I show it as a internal income? No. So when it comes to dividend income, when it comes to what income? Dividend income, 168 and 43,750. 168 and 43,750. In this, within that, one company has paid, one company has received. Correct? For me it is an income, it should be subtracted. For them it is appropriation, payment and all, it will not be there. Clear? clear? So subtract 50,000, take 161,750. Clear? This is for first. So A and B point is for what? Dividend released from Sitara. A and B. I have written C. A and B point adjustment. Okay. Let me go to C point. Okay. C. Chand Limited sold goods of 1,75,000 to Sitara at a profit of 20% on selling price. Okay. Assume we are Chand Limited holding. We are selling to subsidiary. Goods costing some amount, we sold it for a profit of 20% on selling price. Clear? Inventory, now that goods will be there in whose books? Inventory of Sitara Limited. In that 70% of the goods, that amount, like inventory of Sitara includes 70,000 received from Chand Limited. So whatever is the inventory you are seeing, to the extent of 70,000, it is in the selling price. So we have to subtract what? 70,000 is the selling price. In the 20% means how much is the unrealized profit? 14,000 we have to eliminate. Clear? How to eliminate this? Shall I tell you? First we have to find the changes in inventory. First we have to find what are changes in inventory. 857,500 minus 420, 376 minus 301. So that we will do, and we will find what are changes in inventory first. Go to working note. Point number 4, changes in inventory. Okay, Chand Limited, that two numbers, these two numbers, if you subtract, what is the changes in inventory? 437.75. So total inventory which actually we should have added is 512.750 itself we should have added, but there is an unrealized profit which is included in Sitara Limited, which is included in what limited? Sitara Limited. It is eliminated. So this is what we have to show in what? P&L account. So in P&L account we have to show only 14 lakh. How much we have to show in changes in, like 14 4 it should be somewhere 4 lakh, correct? 4 lakh 750 we have to show. Very easy enough. Okay, 4 lakh 98. Closing stock is higher, no? Subtract. Clear? Increases. Clear? That we have to do. So C point is done. D point, selling distribution of Sitara include 21,250 paid to Chand Limited. Okay, who is paying to who? Sitara is paying. So it will be there in the payment side of Sitara, correct? Okay, as what charge? Brokerage fee. If Sitara is paying, for him it is expense, then for Chand Limited it will be what? It will be income. So from income also we have to subtract, and from expense also you have to subtract. Okay, if you see in the last line of the question, this consulting, royalty, brokerage are seen as what? Operating revenue. So if you go to revenue from operations, okay, Sitara is paying, Chand is receiving, no? So if you see that amount whatever they are paying, how much they paid? 21,250. From income also we have to subtract what? Are able to see revenue from operations. From that subtract 21,250. D point means income of who? Income of Chand Limited you are subtracting. Similarly, from payments of who also you have to subtract? Sitara. Are able to see brokerage paid, selling and distribution you are subtracting. Clear? Other expenses. Okay, they have to subtract. Sir, if it is expense for one person, it is income for some other person. So we are subtracting like that. Next, general overheads of Chand Limited include 28,000 paid to Sitara. So what we'll do, you go to general expenses. You go to what expenses? General expenses. Chandan, Sitara, whatever amounts that is there, first you add it. In that you have to subtract what? 28,000. Here you are subtracting 28, and outer column you are bringing 374. If it is expense for Chand Limited, it will be income for which limited? Sitara Limited. So Sitara Limited income is you are adding. In that you are subtracting what? This 28,000 whatever is there. Clear? Next. Okay, Sitara used some of the resources of Chand Limited, and Sitara has paid 5,000 to Chand. Okay, so it will be there in the Chand Limited. Correct? Chand Limited income, we have to subtract 5,000. Similarly, expenses also, these people would have paid something. Correct? So royalty paid. So 5,000 is shown. That entire amount we are subtracting, and we are showing it as a nil. Clear? So royalty, everything first you add, each and every line item you add. For example, selling and distribution is there. Correct? Selling and distribution is there. First you add that. Add and subtract the mutual line. Simple. Correct? You do like that, you will get it. Clear? After subtracting everything, whatever amount. Intercompany sales also you have subtracted. What also you have sales? Intercompany sales also you have subtracted. Everything after subtracting. Okay? This intercompany sale is there now, 175. So intercompany sales. So from revenue from operations, it will be there, no? Subtracted. And from purchases also you have to subtract what? 175. Clear? Subtracted. So simple. First every line you add it and keep it. Adjustment you subtract and add wherever you want. Subtraction will be there most of the cases. Clear? Eliminate and do the value so that your P&L will be done. All the working notes should form part of your answer. Finally, you have to write this profit before tax. Sometimes tax percentage will also be given. 30% means 1051 into that 30%. tax expense subtracted and get the values. Clear akada? Clear? So make sure you are practicing all the sum. This formats and all I have given for your easiness. It will be very easy. And with this, we have successfully completed revision of AS'21 consolidated financial statement. All concepts, all sums I have covered. Make sure you are practicing very clearly. Next round AS'23 and AS'27 will be uploaded in the YouTube channel. That notes will be available in Telegram group. You will fall in love with consolidated financial statement. Watch the class, start doing the sum. One time you do, after one day, one more day. Okay, if you are seeing today, tomorrow or day after tomorrow, practice once so that you'll have control. Write the steps properly, don't change the steps. Correct? So you will get full clarity. Rocket. And make sure after this material, whatever is there in ICA studies material and whatever is there in the question banks completed. Loving you all so much. AS'23 and AS'27 subsequently next branch accounts will be uploaded in Case Academy YouTube channel. Thank you so much. Bye.